took some startups to show them what the potential of the asset class was, and they started investing on the continent. We have countless examples of that. So this is a true testament to what we are about, what the mission is about, and what you are about, because many people in the room here physically in Nairobi or looking at us online. As you know, this event is streamed online and is watched, replayed by a lot of people, is the people investing in African entrepreneurs. This is thanks to who we are. This year we started opening a new frontier market. Every year we go to a new ecosystem. Last year we went for the first time in Togo, Lomé, for a fantastic event. And actually I'm very happy that some entrepreneurs from Togo are here with us today. But earlier this year, for the first time, we went to Central Africa. We've been asked for many years, when are you going to Central Africa? And we've done it for the first time a few weeks ago in Kinshasa. Incredible experience. Well, as much traffic as we have these last few days, but a vibrant ecosystem that reminds me of where Nairobi was 15 years ago when I started working there. And we're looking forward to a European tour. So we have, as every year, our international tour will be kicking off in Europe. So for the first time this year, we'll go to Amsterdam alongside Super Return Emerging Market. So we're very excited about that, and hope to see some of you there. So that's on the 14th of June. And then we'll be in Paris around Vivatech. So, I don't know, it seems we've lost some imagery now. When we do this operation, it's not just a summit, it's side events. So we started this weekend. We had a ventures retreat for all the founders that are taking part in the program. It took place in the southern part of the Nairobi National Park. It was a great experience. And then yesterday, alongside the AVCA event, we had a Wide Connect, which was a sort of a speed dating event, investors, startups, that took place next to the AVCA venue. So today we're here for a fintech summit, and tomorrow we'll be in Amani Gardens. Don't come back here. Don't go to Shamba. Amani Gardens for our climate tech summit. So that is the program. And tonight we have a special event here at Nairobi Street Kitchen for the VC night. You have to register separately for that if you haven't that, but your ticket gives you access to that. So, Dan, do you want to talk about... Okay, so we have the image back. Let's try. One more thing I wanted to speak about is that some of the work we do in the VC community is focused on building open source resources for founders and investors, and it's called Digital Collective Africa. So Digital Collective Africa has been running for 7 years. It basically builds open source resources for the investment and founders community. These resources are co-created. We usually do them during what we call VC unconferences, which we've been doing since 2019. And we've been building a rich stack of resources over the years. So you can check digitalcollective.africa to find all of these resources. We have a working group of 320, mostly investors and ESO, which people that have attended VCN conference and co-contributed to building those resources. So I encourage you to look into the work that is being done there. You have a bunch of toolkits. They're all free to use. They range from governance to how to incorporate your startup in another jurisdiction, etc. You have list of investors, ESOs, venture studios, and so forth, and a lot of content. So please have a look. And if you're keen to engage, you can check that QR code and join us there. I just want to look at the latest release, which is our incorporation toolkit. For a founder, it enables you to make the right decision now. You incorporate it in Kenya, but you need to flip the company to a jurisdiction that is friendly to your new investors, American, Europeans, whatever. So this tool, which is very comprehensive, will give you all the comparison of the jurisdictions from Netherlands to UK to Delaware to Singapore and so forth, and will enable you. There's a little decision tree tool that you can basically, based on your parameters, see what maybe is best fit for your business and your objective. It's quite a useful tool. It's taken a month for us to build that, but it's just been released now officially this week during AVC AfricArena Summit Week. So please have a look. We also have a lot of work on venture studios, so there's a lot of content on that if you're interested in engaging with venture studio to building your company. I mean, personally, running a venture studio in South Africa, I think this is one of the best vehicle to build. But in Kenya, you have great venture studios like Delta 40, Pyramidea, and several more like Purple Elephant Ventures. This is also a great resource. It's an open source list of all the investors active in the ecosystem. There's 590 of them. You can check on that resource, click, see what investors are doing, where they're investing, what sector, what stage they're investing in, and so forth. So have a look. This is a great resource for you to use. And hope you enjoy that. And I pass the mic over to my colleague Dan, who's going to talk to you about another digital resource that we avail to the ecosystem, which is called AfricArena Wired. Dan.
Good morning, everybody. Morning. Thank you so much for coming. Even though we know it's raining and it's a bit cold here, we are really glad that you are here for our 2026 edition. So very quickly, I will speak to you about the AfricArena Wired that you can all have access to. It's available on Play Store, App Store on Apple. And there, what you will find is that you will find basically it's our all-in-one platform where you can review the stuff that we did in the previous years. You can find research that we have run. You can also find some podcasts that we have run, some panel discussion, blogs. We are writing a lot of blogs for our founders, especially when they raise funding, that came to pitch at AfricArena. And then, just for it, we also have a desktop app that is available. You can search Wired Desktop. If you need any help, you can talk to me, and I will show you. And then it's very easy, just a demo that I can show you as well, but it's very easy to register. And then from there, be able to have access, and you'll be able to see everything that we do, our list of startups, and so on. And one feature that we have launched very recently, yeah, you can go next. It's our investor portal. So in the investor portal, what you have access to is our alumni startups, and there you will be able to find their key information, as well as their pitch, their slides, and everything that can be valuable for you to connect with them, as well as seeing what they do, and then make maybe an investment decision if you're an investor. So it's a tool that is only available for those who are registered and passed through our login platform. And then from there, you will have access to all this information. So I think that's all for me. You can scan the QR code. This is the mobile version, desktop version. And if you need any help, I'm here. I can guide you through and give you access to everything. So without any further ado, I will move to the next step. I will call back our MC, and we'll be able to go to the world of sponsors. Thank you so much, everyone. Thank you.
A round of applause for Dan and Christophe. That was nice. Thank you very much. Now I'd like us to go to the next step and appreciate our sponsors who have made this event possible. Let's first give them one round of applause. All the partners, because there's so many, we cannot exhaust them today. Let's do one round of applause for all the sponsors. Thank you very much. But for starters, we have Lauren Opio, the country lead pay genius. So Lauren Opio, if you're in the room, kindly make your way to the stage. Lauren Opio. I believe Lorraine is not here yet. So we're going to go to the next sponsor, who is Eric Odipo, country lead, Silicon Overdrive. A round of applause for him as he makes his way to the stage. Karibu sana.
I'm Eric Odipo from Silicon Overdrive. First of all, I want to appreciate AfricArena for consistently putting this together. And to also join in welcoming you to the 8th edition of the AfricArena tour. And Silicon Overdrive, we are an AWS premier partner. We are really committed to seeing founders, startups, innovators really ground their innovations, their solutions on the robust cloud technologies, more specifically AWS technology. And so we've been involved in the last couple of years, maybe about a decade, just helping founders, just helping startups to build, to test, to deploy, and to scale, using their cloud technology. Sometimes using tech can be a daunting task with this very fast-paced world. But with the right partner, the technology can be your ally. So I want to wish you well. We are happy to engage with you. We have our desk there, and we also will be here throughout the day so that we can continue to engage with you. We can have discussions. Let's network, let's engage, and let's see how we can assist you, especially if you need any assistance with regard to your utilization of AWS technology. And so I wish you a great day. Please engage, network, and enjoy. Have a good day.
Thank you so much, Mr. Eric Odipo. Now going to take this chance to invite Madame Lorraine again from Page Genius. She's here already. A round of applause for her as she makes her way to the stage.
Opio. I'm the country lead of Page Genius here in Kenya. We are actually one of the proud sponsors of the AfricArena Summit. So as Page Genius, we are a payment service provider. We offer different multi-currency channels for your business, and we also help businesses to receive payments internationally and both locally. So in our platform, we have several payment options like mobile money, card, and if you are here and you're a business that has been waiting for a payment service provider, Page Genius is here to help you scale your business. The platform has different technology that is going to be relevant for you to scale your business and to help you save money. And yeah, so thank you so much. Welcome everyone. Thank you. Oh, God.
A better round of applause. That will also help generate warmth. So if you don't clap, you'll end up being cold for the rest of the event. So on to our next sponsor, we have Veto, and I'd like you to help me welcome David Biema, Sales Manager, Veto. Karibu sana, and a round of applause for him. Thank you, thank you, thank you.
Good morning. I know at the back we can barely hear what the front is saying, but the sound here is so perfect. I don't know whether as the host you'll actually get guys to move maybe forward. But good morning, distinguished guests, innovators, and guests at large. My name is Biema David, representing one of the sponsors, Vato. And what we actually do is make payments across the world become like a text message. We make it easier, and we always partnering with organizations such as AfricArena to make certain that our ideas and innovators actually get their way forward. So it's a privilege to actually be in this crowd and make certain that we do connect, make certain that if you're having any challenges when you're making actually or receiving payouts within the Africa continent, or even making payouts to China, the Middle East, or the US or Canada, you actually have a way to go. We'll actually get to speak more. We do have a booth here, and we could actually deep dive in terms of just seeing ways we could collaborate. Thank you so much for this opportunity, and see you around. Thank you.
Okay. Can you hear me at the back? If you can hear me, you can't? Ish. Oh my God. Do I have to shout like that? Okay, fine. Also, maybe for my speakers who will be coming on stage, maybe we can also try to project our voices so that people at the back can also hear from us. At this juncture, I'd like us to go to a very interesting bit, and we're going to have an opening keynote about the state of fintech in Africa. And our speaker today is Hanyul Song. I hope I said that right. She is a data and insight lead at Brita. She's been leading Brita's data and insights across emerging market innovation ecosystems. With the Brita team, Hanyul has developed an in-depth data on startup transaction support ecosystem and FOF data in Africa, Asia, and Latin America. Ladies and gentlemen, a round of applause for Ms. Hanyul Song.
Great. Hi, everyone. Good morning. As everyone said, thanks for braving the weather and getting here. And thanks for inviting me also to speak a bit more about fintech. I know this AfricArena, today and tomorrow is going to be about fintech and climate. And I think it's quite timely that we discuss those two sectors together. So today what I'll do is I'll go through some of our findings from our data collection that we've done based on our 2025 data that leads from 2016 to really today. But we'll really talk about some of the key trends that we're seeing, as well as what I think is coming up next. So with that being said, I'll see if this works. Cool. Oh. I think that's the next slide. Do we have the slide up? Should we wait a little bit? Yeah, no problem. Now I understand the pressure of an MC. And it's like this. Maybe in the meantime, can I just get a bit of an understanding of who's in the crowd? So how many of you guys are actually building a fintech company at the moment, or have been running a fintech company? Okay, so some of the innovators. And then who has worked with fintech and left fintech? Okay, you guys have been loyal. Who's been investing into fintech? You have, okay. And then who's here to just learn more about fintech in general? Okay, that's good to know. All right, so we'll adjust it based on that.
Sure.
Maybe we can, let me ask.
Sure.
Should we do the panel first, and then we'll come to the keynote? Do you want to?
Okay, as we wait for her slides, I'd like us to move to the panel first so that we can save on time and have a seamless transition. I'm also trying to look for my phone. Found it. So, well, I can see the slides are in already. So she's going to do the slides, the presentation, and then we're going to do the panel discussion. Is that okay? If that's okay with you, thumbs up. Thank you.
All right, thanks. All right, we got here. All right, so we'll get started. So just a little bit about Brighter. We have been collecting information about innovation companies and their interactions within emerging markets in the last 6-7 years. We then make this available as an ecosystem data on a platform called Brighter Intelligence, but we also put out different reports, which is also different things that I work on throughout my day-to-day life at Brighter. And today's data, what we will speak a little bit more about is based on the data that we've collected, but also our 2025 investment report that we've done on the African continent. So I know some of you guys are sat a little bit in the back, so I will just talk a little bit about the main points that we'll speak about today. What I wanted to do is just reflect a little bit more on the fintech as an industry within the African ecosystem in 2025, specifically looking back. I know, I can't believe it's almost May, but what we wanted to do is just really look at the last 10 years of trends rather than just 2025, but contextualize it with that, right? So one thing is, I think there was a lot of fear that the ecosystem, investments into the African ecosystem was really declining in the last few years. I think the good news is that last year when we reflect back, it has bounced back to the pre-2021 level. I think fintech still takes a really lion's share in that overall funding. But what I do see is that in recent years, we'll actually see some new sectors actually emerging and diversifying the ecosystem. And third, the market dynamics is actually diversifying across the Big Four ecosystem. The Big Four, the Kenya, Egypt, South Africa, and Nigeria, they're still, again, a big share. But what we are also seeing is that it's actually diversifying a little bit more into other regions. And fintech actually has a role to play in that. And fourth, we have seen actually a lot of exits in fintech, but mainly also by acquisition of other fintechs. I think what we are seeing is a bit more of a consolidation of some of the larger players and also some of the smaller players going into more embedded solutions. So with those key points, I'll go in. So what we've done is that we've looked across thousands of the data points that we have collected over the years, and this is then the presented information is based on this information. Most of them are all disclosed information. There are some deals that we get directly from the investors, and then some of the information about the fintech itself, we also get self-reported from the fintechs or the startups in the ecosystem. That being said, so before we even get into fintech, let's just talk about what does the ecosystem actually look like in the last decade. What we have seen is that there has been quite a bit of an up and down in the last 5 years, and there was a lot of fear about the ecosystem declining after a bit of a peak in that 2021 time. I think what has been quite positive in what we've seen last year is that this is the first time we've really seen it go up at the 2021 level, or at least the growth has been actually positive compared to some of the previous years. And what we're saying at Brighter is that I think it's really going a little bit more into a normalized place. There was a peak, there was a bit of a fear of going down right after those peaks, but I think what we're seeing is that it's actually stabilizing a little bit more. And what I wanted to, this is more about fintech, and what I wanted to say is that actually fintech at the end of the day still has been leading this growth in the African ecosystem for many, many years. Especially in that earlier years into the last 5, fintech has always been a lion's share within the ecosystem. We'll talk a little bit more about this later down in the presentation, but last year and the year before, what we are seeing is that fintech, even though it is a lion's share, we're also seeing it diversifying into some of the other sectors, mainly climate tech and agriculture tech. And we'll discuss a bit more, but we're also now at a point where fintech is no longer the only major sector that defines a lot of the ecosystem. And in this ecosystem, the Big Four still dominates. The lion's share of our funding and ecosystem activities still happen in the Big Four. But we are also seeing the other, which is the dark navy type of color, also increasing a little bit more. Within the big four, fintech still takes a massive share, right? It's actually just in Kenya where this is diversifying a little bit more, where climate is actually entering a bit more into the Kenyan space, and this is also what's driving that climate being a larger sector overall. And beyond Big Four, what we are seeing is that West Africa is also rising a bit more in terms of the interest, the types of companies that are coming out, Senegal and Ghana putting the West Africa a bit more on the map. And these places also, fintech is one of the sectors that are actually leading this growth. So in the previous slide, what we have seen is, okay, the ecosystem has seen a bit of an ebb and flow. This past year in 2025, we've seen a bit more of a positive upstrike in the type of investments or the sizes of the investments that we're seeing across. We're seeing that Big Four still dominates, but still there are some activities that are happening in West Africa. Fintech has been leading this growth, and the growth is still ongoing, but it is diversifying in terms of the sector. So that's been the summary of what we've seen so far. What I wanted to go in a little bit more is going a little bit deeper into fintech in itself. So over the year, what has actually really led the growth of the fintech in terms of the product lines? And I find looking at the products at the fintech level one of the most difficult tasks, because fintech as a sector constantly changes, consolidates. I think the name of the game in the fintech is being able to actually do multiple product and services once you have the right customer base. So go with this, what we try to do here is at least try to understand what is the main entry point for this particular fintech services in actually capturing those customers, right? And based on that, what we have seen is payments, transfers, and financial APIs. So actually both in the terms of B2C and B2B product services, actually leading a lot of the fintech movements within the African continent. We have seen some times where credit, if there is available debt loans and things like that can back these credit companies up, also entering into the map, but a lot of the times it's still at the API and the payment systems that we really see a lot in the market. And what we are also seeing just across the years is that there has been actually a growth in the Series A deals in 2025, but the other deals in the pre-seed and seed, the median size has really been quite volatile over the years. And we'll talk a little bit more about, I think, the implications of that. The positive, again, in the 2025 is that we're seeing a little bit of the growth in that seed stage, but the other ones, I'm still in question about how well companies are able to grow at the earlier stages. And to just kind of put that median size funding a little bit more, what I've looked at is looking at the ticket sizes of the all fintech deals that have happened across the last 6 years or 7 years. And what I'm seeing is that very early stage ticket sizes before that 250K, which is dominated by mostly ESO grants, very, very early stage, angels, those as well as deals that really are more at the seed funding stage, which is 1 mil to 10 mil. That seems to be within the range of the median size funding for seed funding. Those have been they've been in a good shape in terms of there are more funding available on those type of ticket sizes. Where I think it's squeezing more so is in that pre-seed stage. The deals at that very post first support into going into seed stage, we're just not seeing as much deal flow in that place. So I'm calling it a bit more of a compressed pre-seed or compressed early to middle, but we are also seeing some of the larger deals actually still happening. So I don't think it's to say the funding is completely changing. I think there is just more of a compressed part in the beginning, and then there are more happening at the larger ticket sizes at the moment. And fintech has really grown a lot more through commercial funding and equity funding, although we are seeing in the recent years that grant funding as well as debt funding has been growing into funding these companies. And I think in this case, most of the debt funding is for credit companies. And this actually, I think, is interesting because this really differs from the rest of the African continent ecosystem, where almost 30% at this stage of many of the ecosystem early stage funding is debt. So compared to what the rest of the sectors look like, fintech is still mainly driven by many of the equity as well as commercial funding. And commercial capital is still re-entering these markets after some time apart. Many of the commercial funders, as well as we've seen in the very first slide we've seen with the curve, they've really left a lot of the the innovation ecosystem. And then the local funders actually have been holding down the fort as the funders that are more globally based have gone and come back into the ecosystem. But as we see, as the 2025 has stabilized a bit more, all these, I think the funders that have left that are a little bit more commercial, global, they have returned a bit more into the ecosystem last year as well. And in the fintech world, in 2025, we've actually seen the highest number of exits, especially in the fintech sector, which is the yellow part there. But a lot of these exits, what we call, are not necessarily exits not necessarily exits by corporates or PE firms. A lot of them were actually startups buying up each other. So this is the point that I wanted to make a little bit earlier about, I think with fintech world, we're entering into a bit more of a consolidation stage of larger companies buying up smaller companies or companies that have a good customer base that they can really enter into. And that's the consolidation that we're seeing more so than, I think, attractive exit options for banks or other corporate options. So we've spoken a lot about what the landscape looked like. Landscapes are ebb and flow, but it's grown in 2025. Okay, we established that. Fintech has been a lion's share. It's changing a little bit. We've established that. It's led by a lot of commercial funding and equity funding with a little bit of debt funding entering into the space. So what now? I wanted to talk a little bit more about zooming in into that 2025 sector diversification a little bit more. And I think it's quite timely that we're talking about one day fintech, tomorrow climate tech, because climate tech has really entered into the ring, the ecosystem in the last few years. And in particular in 2025, it's actually taken over fintech's funding share as renewables and climate funding has actually overtaken that. Many of it is because a lot of the renewables and climate tech really has been leveraging debt funding as well as larger scale DFI funding going into some of these quasi-infrastructure projects. Compared to fintech, which I think is a lot more commercially driven, there's a higher competition across many of the fintech companies. So that's where it differs a little bit. And what I think we're seeing is that compared to fintech, climate tech and fintech are almost completely two different kind of funding pathways. Fintech, again, is a lot more commercially driven compared to climate tech that really deals a lot with concessional funding and concessional funders and different types of funding instruments that come into the place. And then climate tech is attracting nearly twice as much as concessional funding compared to fintech are. And again, it's not necessarily comparing these two sectors as apple to apple. It's to realize that there are almost two different pathways of how a lot of the companies are growing, or two really major sectors that are growing. Fintech still really what I consider as more VC backable, more commercially viable at a very early stage companies compared to climate tech that takes a much longer time for them to develop. Hence, the type of investors that are coming in are much different as well. So, what do I want to talk about it as more of a summary based on what we've seen? One, that squeezed pre-seed stage, I think, will define what kind of companies we'll see next year at this stage. That very early stage support and not having enough support perhaps at that pre-seed stage will also make the competition for capital a lot higher. And being able to, companies need to either stay very small or they would have to raise at the larger ticket size. The second part is that sector leadership that fintech held for so many years is now changing. I do think that this is going to continue to diversify in the next years. And what this also means that the capital will really concentrate in still in sectors where local conditions are really good for companies to grow, but also for investors to invest into. And fintech continue still, I think, still a good first entry point, especially in markets where it's not the big four. If you earlier when we're looking at that diversifying landscape in terms of innovations coming out of the big four, if you do look at who's really in that first entry points for some of those smaller markets, many of them are fintech. And that makes sense, right? There are so many models that have worked in so many different markets that can also be replicated, and it's familiar for many of the commercial investors. So I still do think that fintech is very relevant as that first entry point. And then fourth part is blended capital stack. It will also define, I think, who's really going to be showing up more on these analyses that we do over time. And But with fintech, I think something to learn from the climate tech landscape is that climate tech landscape has really utilized many different types of funding instruments. It's innovated a lot. It's innovated into bringing in more concessional funding, longer debt instruments. With, I think, fintech, and during the panel we'll talk about it a little bit more, but is the sector as a whole also innovating the way that these instruments are innovating in some of the other sectors? Are there enough debt actually going into many of the credit fintechs that needs those type of debts? So those are some of the capital stacking that needs to be, I think, come into a play when we talk about the next stages of the fintech. And then fifth, I think larger fintech solutions are consolidating. My big question that I want to learn during this summit this week is then how are the smaller fintechs also supposed to then survive? I think it's time for us to also look beyond some of the largest players, because what we're probably not capturing when we're just looking at fintech these days is all the embedded solutions, embedded financial solutions that we're seeing in sectors like agriculture, climate tech, e-commerce, logistics. Fintech is everywhere in terms of those sectors, but so I think it's no longer fintech as a standalone solution, but fintech solutions going into many of the sectors that I'm looking forward to seeing in the next stages of our analysis. So with that being said, I hope this helps set the scene a little bit as we go into the rest of the summit, and look forward to meeting many of you after. Thanks.
Well, thank you. Do you have any question? Just one? A question? No? Am I loud enough for the people at the back? Okay, so since there's no question, so we're going to go directly to our panel discussion. And Song will still be our moderator of the panel, as I ask the technical team to help us with the seats at the stage. So I'm going to quickly invite our panelists, starting with Rathika Bachu, co-founder and CEO Ndovu. A round of applause for her as she makes her way to the stage. To quickly invite, we also have panelists, starting with Rathika Bachu, co-founder and CEO Ndovu. A round of applause for her as she makes her way to the stage. Thank you. To quickly, we also have Abhinav Nehra, former CEO and Managing Director, CIB Kenya Limited. A round of applause for him as he makes his way to the stage. Also, kindly make sure you sit in the order of the screen. Thank you. Thank you. Moving on, we have Hilda Morab, Abhinav Nehra, former CEO and Managing Director, CIB Kenya Limited. Tech team. I can hear. Oh, thank you. Hilda Morab, founder and CEO, Pezesha. A round of applause for her. And last but not least, we have Mike Mompi, Managing Partner, Enza Capital. A round of applause for him.
One of the microphones. Hello, everyone. Me again. Welcome to the panel, everyone. So I think today what we wanted to do is, I think, just start off not just as an introduction of who you are, because I think many of the rooms already heard the introduction, but I think as you guys are on slightly different parts of fintech, I think some of you guys are innovators, some of you guys have been investing in a long time, you've been in the financial industry for a long time. What's one thing that you learned from fintech industry last year? What do you want to learn a bit more, or what are you expecting in 2026 as we're actually already at the midpoint? So I think just as with your introduction, I think it'll just be really good to hear a bit of your reflection from last year and what you're looking for this year. Thanks.
Okay, fantastic. Thank you. Hi, everyone. My name is Mike Mompi. I'm one of the co-founders of Enza Capital and the managing partner there. Enza is derived from the Zulu language. It means to build, to make, and to create. And we back founders and teams using technology to solve large and meaningful problems across the African continent. So we're a multi-stage venture capital fund investing from pre-seed through to Series B 250K up to 5 million per company. So to respond to the prompt around fintech, I mean, fintech permeates almost any and every, I think, business vertical within the African continent. So I saw the numbers, if you look at kind of health tech, et cetera. Ultimately, if businesses are to generate income, they need to collect that income somehow. They need to kind of manage their statements. And then usually that also leads to access to capital because the continent is so capital constrained. So then there's this evolution of access to capital, and then how are we credit scoring? So I've always had the view that almost everything on the African continent is or will become kind of fintech in one way or another. If I just speak to maybe 26 and beyond, one of the things that we're spending a lot of time looking at is AI and how AI is going to impact the world, Africa, and also some of the industries. So specifically for fintech, you can give an example of technology that enables voice to text, for example. So if we're working with under-resourced languages that don't have large LLMs, where you're speaking a local language or a local dialect, you could now imagine someone who is illiterate but who speaks a local language, explaining their sales, their inventory into an application, and then generating 3 statements: income statement, cash flow, balance sheet. And on the back of this new information that is now structured in a way that traditional institutions can assess, there is the opportunity, I believe, to expand access to financial services for a broader subset of Africans across the continent. So that's kind of one example of how we think kind of AI will start to impact fintech across Africa. Many more examples, but I think the other direction that we're seeing is stablecoins. So transaction costs are incredibly high, particularly due to FX and the lack of regulatory consistency across many African nations. And stablecoins, we have seen, are being increasingly used to bring down the cost, to increase the speed, and completely changing the landscape. So I think it's going to look very different in about 5 years' time than it does today.
I'll be very quick. My name is Hilda. I'm the CEO and founder of Pezesha. What we do at Pezesha is we've spent the last 9 years building this MSME infrastructure that allows small and medium businesses to access credit. These are the underserved, banks are not touching them. And we've built this alternative credit scoring platform for the last 9 years. And I'm emphasizing 9 years. It's taken us 9 years to set up this infrastructure to allow small businesses to be included. And that's why we can now collaborate with banks to come on board to basically offer local capital, because we've proven the model, and now we can layer local capital on top of it. We're in Kenya, Uganda, and now in Tanzania. So to just answer the question on what has been happening in the landscape and how I see 2026, we're basically at the maturation point. And in many ways, it's very uncomfortable for us as fintechs who are operators and building. It's also very real, because I think the future is going to favor the guys who've survived now and are going to continue to survive. And this is actually the testing moment of who's going to survive the longest. It's not going to be who has the most amount of money in the bank anymore. So it's really an interesting time, because it's going to define survivors. It's also a consolidation moment, because a lot of things are happening on that level. We've seen fintechs and banks collaborating, local fintechs being interested to buy a stake in fintechs. And we're going to see more of that this year. We're going to see local debt flowing in different forms and shape. For example, for us as Pezesha, 80% of our debt is local. From local banks. And of course, CIB is actually one of our funders in terms of our balance sheet. So we're very excited that local banks have started to warm up. And it's taken time, but here we are, VC global debt is drying up. So we're going to see a lot of that. We're going to see a lot of consolidation on also fintechs changing their business models beyond credit. What else can be added on top of that layer? Investments, and other things. Of course, SaaS models. Not forgetting all the conversations on SaaS apocalypse. But that's a story for another day.
Morning, everybody. My name is Abhinav Nehra. I was the CEO for CIB. I've spent about 35 years in banking across the world. I would say banking, payments, technology, all across. Before CIB, I was heading Africa for Network International. What I find, what I find missing in fintech in Africa is that fintech in Africa is actually majority payments. I don't see any traction in fintech in Africa on the credit side, whether it is credit for the consumers, whether it is credit for MSMEs, as Hilda mentioned. Very little work is being done, but if you see Africa, and I've spent 15 years in Africa across the continent, a lot of it on the western side of Africa, I see very little traction or very little appetite, whether it's with the fintechs or with the banks, with regard to MSMEs, because MSMEs and consumers form the core of any emerging economy. So I think there's a lot of work, and the work is, in fact, I launched something which was a quasi-fintech in India about 25 years back, which was called City Financial, which was basically loans for subprime consumers, right? And I did see a very little work being done here, and those were the times when we didn't even have digital rails. I think today we have very, very strong digital rails in terms of mobile money, wallets, etc., which is the very, very crucial data which can be used to now do a risk-based models for consumers and MSMEs. I think lots of work needs to be done there, and I'm personally working on that. So I think that's my take on this.
Good morning, everyone. My name is Radhika Bachu, and I'm the CEO and co-founder of Ndovu Wealth Management. And at Ndovu, we empower Africans to take their hard-earned money and achieve returns responsibly. So you can come on our platform today, and you get access to a money market fund, all the way to a multi-asset special fund, and also access to exchange-traded funds and shares. And just as a highlight, we now serve over 200,000 clients, and last year's return settled at 28% on the dollar. And what we saw last year was that fintech was at 1.0, where fintech was mainly about bringing each and every person into the economy, being able to transact, being able to open an account. And what we look to see as fintech 2.0 is, what do you do now that you're in the system? So are you borrowing in order to raise more capital to grow your business? Are you borrowing to buy a car? Are you saving and investing to create wealth in the long term? And we're starting to see pockets of that, and I agree with Abhinav, there's a lot of work we still need to do, but I'm really excited to see that happening. And then secondly, I do think AI will very much increase the speed and efficiency at which these services are provided. And for us specifically at Ndovu, a private wealth manager typically would cost you anywhere from $10,000 to $15,000 a year. Now you can provide that financial advisor in a pocket at a very low cost, which I think will be a game changer, bringing people along the financial literacy journey. And then lastly, in terms of stablecoin, today on Ndovu we have customers from Botswana, but it takes them 45 days to send us funds. It gets stuck at KYC in between banks. There's this crazy stat that 73% of local transactions to move from one bank account to another in neighboring countries are all have to exit Africa to come back to Africa. And so stablecoin will allow us to do that at speed. I think the cost remains a question, but to do that at speed, but it's a game changer, especially when you're talking about easy settlement of funds.
Yeah, thanks everyone for really actually interesting insights. And I mean, if I actually think about kind of fintech 1.0 in the African context, I think, was very much mobile money, payments, that system. I actually think the FinTech 2.0 might have been then connecting that into credit services. I think focusing a little bit more on financial inclusion in terms of actually gathering more information on those payment systems, customers. I mean, then is FinTech 3.0 actually going a bit more of a B2B model? Do you think that's where the transition is happening in the FinTech world? Where I think, Mike, you spoke about FinTech exists in every element, and I think, Pesha, you guys are doing actually SME. Banks need to be involved in actually backing then these SME models, and you guys are actually working still at the consumer level, but you need to connect with then financial regulators to be able to make this work. So all that being said, I think we're seeing this transition from B2C model more to embedded B2B models of FinTech. But what does the sustainability actually look like for this FinTech 3.0 as we're entering into this? I mean, is the answer actually more debt, more local banks actually backing them? Is it you guys actually expanding more vertically? What do you think about what sustainability really looks like for this new stage of FinTech?
Let me take this. Yeah. So I think, as you said, FinTech 2.0, FinTech 1 was all about payments and mobile money. And as you know, Africa has made a lot of progress or is a pioneer in mobile money. But I think it's not been mined. The mobile money or the data rails have not been mined properly now for it to now seep in deep into the consumers. There's no lending. Today, a nurse at Nairobi Hospital or, a worker who is earning 40, 50,000 shillings, he still goes to an informal sector to borrow, right? Even though we have a lot of powerful data on him, right? Now, the issue is some of the bigger banks who are still in their comfort zone and remain very risk-averse. And it's across Africa. I worked in Nigeria, I worked with EcoBank, across all the 34 markets. The banks just refuse to open up to consumer credit, right? And that's what needs to happen. And that's what, if you see today, a Brazil market or an India market, the reason the economies have now opened up, because once you put money in the hands of those consumers, and once you put money in hands of MSMEs, that's what turns the wheel or gets it going for the economy.
Yeah, I mean, for us, as operators in the B2B space, I definitely believe the 3.0 will have a lot of B2B because, of course, we're seeing the margins in the B2C continue to be compressed because of what's happening in the current macro, where there was DFIs providing concessional capital, it's dead. Where there was much more patient capital, which will stay much longer beyond 7 years, it doesn't exist, it's almost misaligned. And so we're going to start to see a lot of fintechs embrace B2B models because they want to survive, they want to scale. And really the premise of it is going to be also how do we open up the infrastructure, the ecosystems. Challenges, of course, notwithstanding, because data is going to be a big one. Are people willing to share data? Are people willing to integrate? And we've started to see banks warm up to that. For example, for us, we've just partnered with a bank where they are using our APIs for their alternative scoring for SMEs. And we're, of course, leveraging all the data that they are sending to us from corporate customers. And so we're able now to lend to even small retailers at the shop because banks have also started to realize if they don't jump this wave, then they're going to be left in the same story as Nokia. We all know the story. And so we're starting to see it happen slowly. And so this particular bank is saying, hey, let's integrate with you. We have 17 countries we can scale to, one API, 15 anchor partners, 700,000 customers at the retail level. Let's go. Of course, there's going to be a lot of work, a lot of nuances, challenges, but I think that's the only way that's proving to work right now for fintechs to scale. And get their unit of economics to start making sense beyond the small margins of B2C. Because now then, with that model of B2B, you can unlock more sustainable, profitable capital or income without having to take risk on your balance sheet. Because the biggest challenge for fintechs now is, do you want to continue to raise debt at a very high cost that wipes out your entire equity? So the trick is, how do you balance those models? And B2B is going to play a key role to drive that sustainability of unit of economics instead of growth at all costs.
So for us, B2B is already starting to be a very important strategy. As you can imagine, acquiring a B2C customer is very costly. And as much as I want to talk about financial inclusion, that is our long-term impact. But on our B2C side, we are a little bit more focused on the formal economy. But what we recognized was that 85% of Africa is informal. And if we don't partner with banks, telcos, larger companies who serve the 85 informal, someone else will do it, and actually we're not creating impact. So what we've done, and you mentioned a little bit about embedding fintech within every single sector you can think of, we've embedded our savings and investments with banks, telcos, scale-ups who target that individual earning $10 a day. So for us, we're already a B2B, even though primarily from the outside we look like a B2C. And it will be really interesting to see how this plays out over the next couple of years. But I do think it is really difficult to build the pipeline and the trust that these large companies have already done. And it will take a lot of capital and a lot of time. So for fintech, it's important for us to partner with telcos and banks to be able to get to those customers. And I see a lot of fintechs doing the same as well.
Yeah, I'm happy. I think fantastic comments from colleagues on the panel. I mean, fintech 3.0, I think this is the first time I've heard that kind of term. So it's like, oh gosh, I don't know if we're ready for fintech 3.0 or kind of what that is. I think it's apt that we're having this conversation here in Nairobi, Kenya, where Safaricom sits, M-Pesa was launched, and everyone globally looks to Safaricom and M-Pesa as a pioneering technology. Now, the challenge is that they have been a pioneering technology for such a long time and sitting on the definition of what innovation is around fintech and financial technology on the African continent. They've partnered with many businesses, which is fantastic and which we encourage. However, they've not acquired a single company from the market. And that, as an investor, has created, I think, a fundamental challenge when it comes to building a pipeline of innovation and growth of businesses who could probably execute much better than a large institution who has done well to innovate, but needs new talent and new ideas to build new solutions. So I think that's just one thing on kind of what is FinTech 3.0, and just a point on Safaricom. And of course, if anyone from Safaricom is here, very happy to chat afterwards and see how we can change that. I think democratization is a key part of this next wave. And at Ndovu, I know, for example, including access to global products is absolutely key. So I think we're going to see more technology that enables more people to access more products, and particularly not just local products, but products across the African continent. So the African Free Trade Continental Agreement, we've been hearing about it for a long time. We haven't really seen much, but actually putting that into practice and decreasing the cost of trade, decreasing the friction between local economies, and then also from Africa out and out back into Africa. And once we further democratize and globalize access to these products for a range of individuals and companies, that should then decrease the costs and give us more of an even playing field. So what's the technology that underlies that? I think a lot of the technology is here already, and we'll be building the kind of foundations and the rails for this kind of FinTech 3.0.
Hopefully, right?
Just one comment on that. I think we work with Safaricom, so you can ask me questions as well, because we've integrated and, of course, to tap into their distribution. it wasn't easy. 2 years of CBK to get approval, to integrate, it's just a lot of work. So I think also, most probably also, the problem is not Safaricom. It's also the fact that they're a monopoly. The regulator has definitely hold them, by the neck in everything that they do. Because if it's taking Pezesha 2 years to get regulator approval to launch a product with Safaricom, by then your business model has changed. Yeah, so it also needs to start at the regulator level to basically say, here's an opportunity to now open up infrastructures like Safaricom for other fintechs to come in and integrate, and Safaricom to start seeing themselves as partners, not competitors to fintechs. Because when we walk in there, there's already a line of, are we together as partners or are we going to compete in future? Because data sharing is complex. Getting governance is complex. Getting approval is complex. Getting the product to go live, everything changes by the time you realize you've wasted 4 years trying to get something to go live. So I think we also need to talk about the regulator level to make these things easy for people like Safaricom to acquire, for banks to acquire, and also just to start seeing the 3.0 become, this ecosystem that we're all imagining.
Brought in a very valid point. I wanted to bring that. The regulatory and the political environment. As you mentioned, so Safaricom was a pioneer, but in the same country, there was no interoperability till about 2 years back. So you have one operator which operates with 95% market share, right? Which obviously curbs innovation. Vis-a-vis, if you compare that with today a market in India, the payment system built over the last 20 years, today, you do what? Maybe 10 billion transactions a month, and those are free. So let's be truthful. M-Pesa could be the pioneer, but it's still the most expensive one. Today, if you truthfully ask me, my driver and my mates still tell me, don't pay me on M-Pesa, pay me cash, because they feel that pinch now.
I think this makes me reflect on some of the funding analysis we've been doing, which is that we're just not seeing as much very early stage funding, which might mean that fintech as a standalone company no longer is, I think, as attractive to some of the investors, given that there are so many growth models. That does mean then there are more seed, Series A onwards funding that we're seeing, but with exit models that look more like startups buying each other. Part of it, I think, is a regulatory concerns, the time it takes for larger entities to purchase, so it is a bit easier of a concept for startups to acquire each other. But in this stage, what does the next exit or the right market signals, what does that even look like for the fintech markets? I think Mike, as a more of a equity-based investors, and I think for the startups, you guys are working towards a certain goal, right? What does that end goal really, or it doesn't have to be end, but what does that potential exit pathways look like for you guys?
Yeah, it's a good question, and we're not sitting here saying we have all of the answers, and I think a lot of venture funds in Africa are working through this same question with our portfolio companies, and the LPs, the limited partners who invest in the venture funds, are also asking that same question themselves. They're all at the Radisson Blue and Upper Hill right now, having workshops on exits and ensuring that there's liquidity in the market. So it's a very live conversation. We also have Paystack here, which is a fantastic outcome, and it's a story that the African continent speaks to a lot as an example of where liquidity can come from. Look, what's happening in fintech payments, which is where a lot of the capital has gone, is there's pressure on margins. There's more competition. There's been a lot of capital that's come into the market. You have Paystack, Flutterwave, Peach Payments, and a handful of other companies. We're investors in one of the payments companies. Grow the business to a certain scale within local economies. And then what's absolutely critical is that to scale across multiple markets. Because to sell a payments business, you're either going to have a local buyer who wants deeper integration across the African continent, or an international buyer who wants new access to the African continent when it comes to payments. And so there are two strategies. One strategy is to raise a lot of money and to pretty much outgrow any of the local buyers, because you'll be acquired for $1, $2, $5+ billion, and there is no one who is sitting within the continent with that balance sheet and that willingness and that appetite for the pricing expectations that a lot of these companies would have. Then there's more of a local strategy where you go around, you buy licenses, you get coverage, you build your revenue, you build a profitable business, and then you look to sell for $200, $300, $400 million, which is a lot of money. That's a fantastic and a huge outcome, and we need to see more of those. We're working on some of those now, and I expect that within the next 18 to 24 months, at Network, you've probably seen your fair share with DPO, et cetera. And so I think within the next 18 to 24 months, we will see movement when it comes to exits and liquidity that will be driven by kind of internal organic growth plus some level of consolidation that will lead to liquidity in the markets.
Yeah, I mean, I fully agree with Mike, and we're starting to see, of course, from an investor lens, those conversations even happening. And for us as operators, it's interesting times as well, because we are seeing companies or fintechs that are way ahead in the Series B, Series C companies now saying, look, we need to look for companies that are smaller, and we enter new markets, or come in at a much more lower valuation with a bit of cash, a bit of share swap, and merge and join hands together and build something bigger. And those conversations are actually happening. I mean, especially in our industry as a fintech credit side, we're seeing a lot of that. New companies looking to enter the market, especially East Africa or across Africa, and they are global. Basically, those conversations are actually happening as we sit here. We're also seeing quite a lot of conversations on how can we leverage our assets and combine our assets to build a much more bigger company. The asset, of course, if it's a credit business, it's your loan book, it is your customers. We're starting to see, for example, potential conversations on fintechs in the credit space that were focused on consumer that want to come into the MSME space. And so they will talk to companies like us, for example, that have been focused primarily on MSME and say, how can we join hands together to build a bigger balance sheet, a bigger asset class, so that we can actually combine and complement each other. And I think lastly, these conversations are going to be very hard and complex in nature, because some of us or most fintechs really didn't build, in this very strong foundation and infrastructure. So they're still going to take time, even within startups, to figure out where the value is going to interlock. Unfortunately, we've also seen startups that have bought each other, but then 3 months later, 6 months later, they've gone their separate ways. And I think it boils down to governance. You walk in the house and you realize there was no governance in the other company, no matter how small they are. Secondly, investor interest. You want to go one direction, your investors want to go another direction because they want to optimize their returns. So those conversations are going to be important to align, even within startups, leave alone big boys, before those kind of conversations actually happen. Because the question is not going to be whether the exits will happen. I think the question is going to be whether those exits will actually lead to something bigger for the ecosystem that will actually change the whole picture, leave alone the IPO conversations that are happening, because Africa is still early for those conversations. So I think we really need to think about those frameworks, because they're going to define the next wave of innovators.
Thank you very much. Other panelists, anything to add?
Yeah, I think, again, a lot of work needs to be done in the synchronization of the regulatory framework. Because it's not about a Kenya, it's not about a Uganda, it's not about Tanzania, it's about a pan-African thing. Africa as a whole has a lot of potential, a lot of opportunity. Now, things like African Free Trade Agreement and FAPs, which are coming in, is something which will really smoothen the process, right? And then Hilda mentioned about the governance part. I think that's something, again, a lot of work needs to be be done, and again professionalization. Even bigger, truthfully, bigger fintechs like Flutterwave and all. I think the promoters now taking a back seat and bringing the professionals to run it is what is going to make a difference. You know, promoters holding on to it is something which is not going to help. And a very clear example of that. Network was a company which was run by Emirates NBD. They hived it off, right? They went on, they did a few acquisitions on the continent, and then they went and listed it in London Stock Exchange. And then even somebody as big as Brookfield came in and bought it over because they saw value in it.
Yeah, and just so I agree with everything that was said here today, but I always say three things. It takes an ecosystem effort to drive liquidity. And so it's the investors, the operators, the traditional banks, the regulators who have to come together. And we've not necessarily seen that happen in this market yet. And then secondly, I'd like to add on, there's also not enough education. Enza had done a very great panel on exits and liquidity on stock exchanges, and they brought in someone who listed, I think it was Africa Eats, who listed in the Mauritius market. So as much as IPO isn't really a thing today, there also isn't education around that for founders to understand that milestone isn't actually that far. If you're doing $10 million in revenue, and you don't even have to be profitable actually to list, but there's not that education around. So I think there's a bit of work to be done in that space, and it comes as a collective effort.
Yeah, thank you very much, everyone. I think just as we wrap up, I would like to then summarize what we discussed. I think what we're saying is that this pathway towards exit or liquidity is still ongoing. There's still a lot to be learned, but there are different strategies that emerge, which is part of it is it's still a scaling game of scaling enough to also attract a whole new set of international buyers or bigger players to come in. There's learnings to be had from the consolidation efforts that are happening in the ecosystem. And then there's still the ecosystem engagement and learnings that we need to do to also train people what those different pathways look like. It's not just a simple Series A, D, C, D, and then IPO exit in the African ecosystem. What does that actual revenue-driven growth look like for some? What does it look like for some to grow more exponentially, as I think, Mike, you were mentioning? What does it look like for more of the SME-facing companies to actually grow as a stable company that actually services SMEs? So I think the conversation is that we're still to see what's to come, but I do think that there are different pathways that are emerging, and looking forward to where this conversation goes next. So thank you very much, everyone, for decades worth of expertise and your thoughts. Thanks, everyone.
Thank you.
Thank you. Okay, maybe you can still remain on the stage for a group photo. And also, is there any question? Just one or two to the panel? Any question? Okay, he has a question to the crowd.
I have a question, but it's a plant. Because we're investors in Ndovu. And I'm just curious here, who has heard of Ndovu? Okay, all right. So, and for those who've heard Ndovu, have you invested any money through Ndovu? Okay, we need to fix that. So, you said 28% on the dollar last year?
Yep, amazing returns. Compared to fixed deposits, that's like 7% on the Kenya shilling. So if your money's sitting in a bank, you're really doing nothing with it. You might as well go spend it. So come to Ndovu and invest and grow your money.
Thank you. So you're all going to stand here now that there's no question, and then take one beautiful group photo. Now you can have your seats. Mike, you can go to the center. All right, thank you very much. A round of applause for our panelists. You guys have done a very good job. And I think for me, I was also wondering, like Mike, we are at FinTech 3.0 already. Probably I was stuck, and I was so, probably I felt like I was getting into the conversation when you mentioned Safaricom and M-Pesa because I'm Kenyan, and that's probably the only thing we relate to when it comes to fintech. But I'm glad that we've had an extensive talk of fintech, and I'm going to see what I can do with Ndovu, or how I can, invest in Ndovu. So thank you very much for that extensive panel discussion. So moving on, I'd like us to, we're going to have our judges, or we're going to have a pitch challenge, our first pitch challenge of the day. But before then, maybe we can stand up and stretch a bit because we've been seated for a very long time. So can we all stand? Can we all stand? Thank you. And then we're going to write numbers with our bodies. So we're going to write 1. One is like this. You stand still. And then we're going to plus. So 1 plus 1. So we're going to do 1 plus 1. Okay? And then it equals. Now that's a 2. This is a 2. Okay? So let's try that together. So 1 plus 1 equals 2. Thank you. Now 2 plus 2. Okay, we go to 2. 2 plus 2 equals 4. So let's do that together. 2 plus 2, 2. Plus 2 equals 4. And then what is 4 plus 4? 8. So we do 4 plus 4 equals. Thank you. You can have your seats. Thank you very much. So I'd like to invite our judges for the next session. That's the FinTech Seed Pitch Track 1. So I'd like to take this opportunity to bring back Rathika Bachu, former CEO and Managing Director, CIB Kenya Limited. Please come to the front, to this seat here. And a round of applause for him as he makes his way to the front seat. I'm also going to invite Patricia Lagat, who's the Investment Analyst, Front End Ventures. Madam Patricia Lagat, you're also going to take a seat at the front here. So a round of applause for her as she makes her way to the front seat. Thank you very much. Next, we have Sean Karanja, Associate Venture Support, Delta 40. Kindly take a seat right here. And last but not least, we have Mr. Eric Odipo, Country Lead, Kenya Silicon Overdrive. So you're already seated at the front. Thank you very much. A round of applause for him. Mr. Rathika, we're waiting for you. Thank you. Now, for the startups that are going to pitch, we have 5 minutes to pitch and 2 minutes for questions from the judges. All right? If you can hear me, clap once. If you can hear me, clap twice. Thank you very much. So for the startups, you have 5 minutes to pitch and 2 minutes questions. I'm going to keep the timer and I'll let you know once we are past the 30 seconds mark. Is that okay? All right. So first on stage, I'm going to invite Pay Genius representative. A round of applause for her as she makes her way to the stage yet again. So remember, 5 minutes to pitch and 2 minutes questions from the judges. And if my success they disturb you, if you know the money, know the
I'm alright. I'm alright. Take your time. Take calendar.
So shall I start? Okay, my name is Lorraine. The slides are moving. Yeah. My name is Lorraine Opio. I'm the country lead at PayGenius. PayGenius was founded in 2015 in South Africa. And a decade later, we are now not only in South Africa, we are in Kenya, Tanzania, Uganda, Zambia. And the other markets that we plan to move into is Zimbabwe, Mauritius, Namibia, and Botswana. So our solution is built for these three major industries, which is the hospitality industry, online travel agents, tour operators, and also e-commerce platforms. So what problem are we solving? So we have seen that 30% of online sales are usually lost due to revenue. We're going to look later into the slides how PayGenius is going to help solve that problem. Another challenge is compliance gaps and vulnerable transactions, and also broken checkout experience. So how do we solve these challenges? One is through revenue growth. So with PayGenius, you'll have a single platform that is going to help you receive multiple currencies through multiple channels. Two is we reduce the manual work of reconciliation because all your transactions will be bundled into one platform where your accountant is able to reconcile better. Instead of pulling an M-Pesa statement, bank statement, you can have all your automated reports in one place. The other thing is in terms of enterprise-grade security, so we are PCI DSS Level 1 certified. We also offer 3D security for all our transactions. And we also have the 2FA for login and to protect your dashboard. 3 is compliance and fraud prevention. We are compliant with most of the local regulatory and AML requirements, and as well, So for seamless payment experience, which is number 4, the platform is designed to help your customers pay you better, meaning we are giving user experience where they don't drop off at the checkout, which happens with many platforms. And so these are some of the payment channels that we are offering. One is the developer-friendly APIs, which allows your developers to integrate our payment solutions seamlessly, whether it's through an app or a website or a business system. In terms of payment methods, you can see we offer Visa, MasterCard transactions, Union Pay as well. We have Airtel and M-Pesa for mobile money. And for the local customers who want to pay using bank transfer, we are connected with PesaLink. Lastly, we also have these branded payment links which incorporate your logo, and you're able to send this to your customer abroad through email, WhatsApp, or SMS, and still be able to receive a payment even if you don't have the infrastructure or you don't want to spend so much on building a website. So if you are working with us, you'll be working with a tried and trusted solution because we have 15 years of combined experience in the fintech space, and we are actively serving 500 plus merchants today. Our total processing volume per month right now is $5 million, and we are proud to be voted ABSA Payment Solution of the Year last year in 2025. In terms of pricing and onboarding, we start at 3.5% for card payments, but our pricing is flexible based on volume. So, and in terms of onboarding, the process is quite simple, as you can see. So this is the team behind our success. and my time is up. But if you've been searching for a payment service provider, please look no further. PayGenius is here to take you every step of your way. Thank you.
A round of applause for her. Judges, any question?
Hi, Lorraine.
Hi.
Thank you so much for your presentation.
Yes.
I do have a question about your user profiles. So you've mentioned you have a lot of traction and about 500 different businesses use this product. I just want to get a sense of what kind of businesses are these? As you know, there's large blue chip type of customers and then these smaller SME types. Just give us a sense of your customer profile.
So for us, it's all types of businesses. As long as you would like to receive payments online, we have a solution for that. So if you have a website, we integrate, we have APIs for custom websites. If you want plugins, we have ready-made plugins like WordPress. If you are just, let's say in the hospitality industry, or you offer a service and you don't have a website, we have the payment links. So it's a payment link that already exists in your dashboard. All you need to do is feed it with the information of the client who's paying. Once you send it out through email, WhatsApp, or SMS, they receive the link, they pay, you receive an instant notification in your dashboard with the payment. Yeah.
Question from me. Thanks, Lauren, for the presentation.
You're welcome.
Just because you're targeting the kind of profile customers you're targeting, they tend to already have ERPs or other systems in which the finance team works off. And so have you thought of, or is there a provision to integrate to existing systems, or is it in the pipeline?
Yes. We can integrate, using the APIs, we can integrate to any business system. And currently, when PayGenius started, we were mostly in the hospitality industry. So we have integrated into various booking channels like Knightsbridge, Booking.com, Airbnb, and the rest.
All right, our 2 minutes are over. Thank you very much, Lorraine. A round of applause for her as she makes her way back. So we're going to invite our next startup to pitch. Remember, it's 5 minutes. Remember, it's 5 minutes pitching and 2 minutes for the questions. So I'd like to invite Ndovu on stage. A round of applause for her. Karibu.
Thank you. Hi everyone, I know you heard me earlier. My name is Radhika Batru, and at Ndovu we're building wealth through savings, investment, and tokenized assets. So this is Rose. Rose is a nurse. She works in the medical industry, and unfortunately, growing up, her parents did not teach her how to manage money. And one of the biggest things we're seeing in Africa is that literacy rates in Kenya today sit at 18%. So let me say that again. Financial literacy rates sit at 18%. What does that mean? People understand how to make money, but they don't actually know how to manage it. And it's actually quite a global thing, but it's more apparent in Africa. And some of the other reasons is that they actually lack access to great savings products or investment products. So before Ndovu, today as an everyday African, you couldn't access global markets, yet all of us have a phone or a car or clothing that we buy in from companies that are all imported. And so like Rose, there's 1 billion people in Africa that are experiencing the same problem. So what does Ndovu do? We allow you to invest with 3 clicks into saving and investment products that help you create wealth. And they range from both local and global investments. So today, Rose can come onto the platform. If she's looking to build an emergency fund, she can invest in the money market fund. If she's looking for growth, she can invest in a multi-asset fund managed by ourselves. And lastly, she can actually access shares in Apple, Tesla, or at the S&P 500, which is the global index. So these are and what we recently added is actually we've been training a local model to be able to provide AI advice. And the idea around that is that because financial literacy is so limited, it brings the user along the journey, and it's been able to double our conversion rate. But really the big question we get is this market deep enough? The answer is yes. Alone in East Africa today, the retail private sector market sits at $4 billion in Kenya alone. We started in Kenya, we're in 3 markets, and as we grow and scale across the sub-Saharan Africa market, we think we can definitely hit $100 million in revenue. But what's really exciting is that when we did our analysis last year, 7% of our customers or clients sit in the diaspora. So as much as we're building the gateway of capital markets in Africa and then global, the next phase of our business would be how do we bring US, Qatari, UK investments back into Africa? And I think that really is a really exciting space for us. So we can skip over that. Really what this shows is that it works. We found product market fit. We've processed over $23 million of assets under management. But really, like I mentioned earlier, the real cookie and how we think we'll really scale is by really embedding our solution into existing users that have actually built trust. Building trust in Africa is a lot harder than you think, and we've signed these partnerships. We're live with a really big telco, which you should be hearing about soon. And what this does, it gives you access to 500 million people on the continent. And the way for us to scale is very much to build these partnerships, not just in Kenya, but across the different countries where they have presence. We're the first fintech in East Africa to have 3 licensing, and we just got into the Zambian sandbox. By the end of 2027, we'll have 14 licenses. So how do we make money? We have different ways of making money, but the average rate is 5.2% on the dollar. So for every dollar we earn $5. And as a team, I'd like to say that we all have many years of experience. We have over a decade of years of experience for companies such as BlackRock, Nairobi Securities Exchange, Oracle, and we also have a chairman who actually pioneered the asset management industry in Kenya. In terms of differentiations, I would just say building in Africa is always about execution, and the fact that we've been able to navigate regulatory environment, build B2B partnerships, and grow our assets under management significantly shows that we're the better team in this sector. Thank you.
Yeah, I think I'll just jump right in with my question. Sure. Thanks for your presentation. Financial literacy being a large roadblock to access to capital, but also investing of people's income is definitely a big challenge and one you're solving. I'm just curious how your tool or platform or the way that you get to your customers or educate your customers is incentivizing behavior change towards saving and investing?
Yeah, great question. So I think firstly, we use the traditional channels such as marketing and awareness. But when you come onto the platform, you get assigned a relationship manager. And historically, we were using relationship managers to educate the user, be able to make sure that they're investing for the long term. And our internal goal is that you as a client should come back once a quarter, and we want you to build your portfolio 4x from what you started. But with AI now, actually, there's a lot more you can do where you don't necessarily need a relationship manager to keep managing your relationship. And we're leveraging that to make sure we bring back clients onto the platform and grow over time. But it's really interesting to see that, so really great. In 2024, there was a market sell-off. We saw some clients put in withdrawals. the relationship managers got on the phone. We canceled 75% of those withdrawals. And in Jan, Feb time, when we had the China tariffs, we saw the market sell. But for the first time in the history, we noticed that our clients actually put more money in. So for us and for me, that was a personal win, because it goes to show that our customer acquisition and education is working.
Okay. Can I ask a question as well? I note that management fees is your number one revenue stream, and just want to get your comments on how that is sustainable with increasing competition. Are there additional revenue streams that you're looking at?
So interesting, the question for those of you who didn't hear is, your management fee of 5% is quite high. Let me tell you a funny story. So first of all, we came to market to be the Robin Hood, and it was 1%, and everyone called us a scam because the local CIS market today charges you 2% on a money market fund and 5 to 7% on an equity fund. The minute we increased our pricing, we saw a lot more flow into the business, because the people who are familiar with investing were like, oh, this is actually competitive. And the question around how do we sustain it going forward, we earn an assets under management fee, so that means that AUM that remains on the platform, we earn it yearly. And then secondly, I believe that once we become a household name, we'll use pricing to bring in more, so bring down pricing to gain market share, because I too personally think that fees are really high.
Thank you. Thank you so much. Your 2 minutes of questions are over. I think we'll just have to ask later so that we can save on time. Thank you so much. A round of applause for her. So on to our next startup, and our last for this pitch session, we have Correlation. If we could have the representative on stage, a round of applause for them as they make their way to the stage. A better round of applause for them.
Good morning. My name is Fred from Correlation, and I'm here to talk to you about retail microfinance that works. And we like to say that we are the best thing since the barcode was launched in the 80s. So what we are trying to solve is the problem of cash on delivery. So what happens in Africa a lot is that you have a salesperson that goes and pitches to sell a particular product, and this is specifically for the FMCG, and then the delivery happens the next day. And when the truck comes to deliver, the shopkeeper typically opens the drawer and checks how much money they have. And they say, sorry, I can't take what I ordered yesterday because there's competition between beverages, milk, bread, and etc. So what we are trying to do is to solve the cash on delivery problem. This is exactly what I'm talking about. So when, I don't know whether it can point. No, can't. Every time a customer comes to place an order, a salesperson comes to place an order, they place an order, then you try and deliver, then you invoice, but then at the time of payment, you realize you don't have enough money, and you end up either returning with the goods or doing a partial payment, and so on and so forth, because you're paying on cash. So access to finance is very, very difficult, like you've had, and very expensive, and it typically requires collateral. So what we've done as Correlation for the last 9 years, actually in April, last 9 years, is that we have been trying to solve this problem. We've done it on several iterations. We first worked with MasterCard and Unilever and acquired 28,000 outlets, retailers, so your dukas, your kiosks, your small supermarkets in the neighborhood, etc. And we finance them to a large extent. And they grew. We found that the customers actually grow 15 to 25%. The bigger shops, which typically have more cash, grow at about 15%. The very tiny ones grow at above 25%. The second thing that we solved was that the returned goods for the outlets that are on credit was virtually nil. So you are guaranteed of a delivery when you deliver, which means your logistics costs were significantly reduced. However, cards are not the typical product that retailers at that level know and understand. So they don't know statement dates, due dates, and penalties, and so on and so forth. So this was a bit of a difficult product, but still we partner with MasterCard up to today. But we transitioned this to a banking product, and then eventually we figured out that also banks have a lot of challenges with credit, so their credit teams are very rigorous. And we eventually pivoted. So our third pivot was us lending off our own balance sheet. Like we said, banks make, when you compare ourselves with typical digital lenders, their NPLs are about 6%. Banks are at about 15, 16% today, 90 days. Digital lenders, 6%. When we were operating a product called Jazaduka, which was our retail product, with KCB, we were at 1.7%. And now with our latest product, where we transitioned all our customers to, we are at, our target is 0.1%. Last year we did 0.16% non-performing loan. And we are able to achieve this. Every time I tell people that, they act shocked. Because, first of all, we do credit only. So once you're on Top Me Up, you cannot buy on cash, so we switch you over. And we do that by integrating with the Salesforce systems of our partners, so that we actually override the decision of a sales rep to switch a customer from cash to credit. So you're on credit only, and the anchors sign with us contracts that say they will not sell, they will not allow a cash sale for a customer on our product. That's a stop supply. And then we start dealing with these outlets. We give them a 2-week credit. Am I over time?
6 seconds.
Sorry. Yeah, and then so we have a good team, and we are actually able to control this. What we are looking for at the moment is, so we have a hop, step, and jump plan. The first is to get Kenya to scale at 600,000 euro, and then expand into East Africa, 4 countries, and then expand to Africa in a Series A with a 10 million raise.
Thank you. Any questions?
So, what was your experience with MasterCard on this? What I see is an NPL of 1.7, and you were telling me that MasterCard was even uncomfortable with that kind of NPL levels?
No. MasterCard were not uncomfortable. Actually, MasterCard was very... they're a big sponsor. They're a big fan of us.
More of education.
The problem was the outlets.
Education with the merchants.
Yes. That was the
but wasn't that a very easy problem to solve, right?
No. These merchants, when they get into a problem, they say, just kick me out of that program. I don't want, because I don't understand these, when it's due, it's 10-day cycle, and I'm visited every day, and stuff like that. So it was a bit of a challenge.
1 minute.
Sure. I just have a question about your tech stack. So what technology is enabling this, and what does that look like at an interface level with your end user?
Okay, so we do a lot of AWS, so it's all on the cloud. We have a front-end application that sits on it's an Android application that sits on a mobile. So every sales rep downloads that, with a unique login so that we know this particular sales rep from this distributor is the one that's allowed to sell to that customer, because basically you're booking a loan. Then we have SMS integration. We have basically communicating with the outlets, communicating with the sales reps. We have direct integrations with our partners, the anchors, so the Coca-Colas, Unilevers, etc. Because we want to give a loan based on known verifiable turnover of that outlet. And we do that by getting the e-teams, basically the e-teams sales data from that person, and we integrate that daily. And we review the limits every month. So we have an algorithm that reviews the limits. We integrate with CRBs, various banks, etc.
Time is up. Thank you very much. A round of applause for him.
Thank you.
Thank you. Thank you for that session. Now we're going on to our next session, and we're going to have a keynote speech from one of us who, our next speaker is someone who has been at the forefront of tackling access to affordable and scalable insurance, which remains a major challenge in Africa. So that person is none other than Ted Patton, who's the co-founder and CEO of Turaco, an insurtech company working to make health and life insurance accessible to low-income earners across the continent. So a round of applause for Ted as he comes on stage. And before he makes his remarks, thank you to our judges. You can have your seats where you were before, or you can still maintain the seats. No problem. Karibu sana. Karibu is welcome.
Thank you. Asante. Good morning. So it's humbling being up here right after people like Radhika, who I also would consider a success for what she's building. But Christoph asked me to come and share a little bit of our story of what we've built at Turaco, to just share the problem, what we've built, and kind of what the next stage is, as well as some key lessons learned. So looking forward to being with you all. I don't have any slides, but I'll just talk through it and share some reflections from the heart. So first off, Turaco is an insurance technology company. The problem that we're solving is that in markets like Kenya, the vast majority of people don't have any kind of insurance. So what that means is that when a family in, say, rural Kenya has a medical emergency, the math that they do is, do we have enough money to go to the hospital? If they have enough money at that particular time, then they can go. If they don't, then they don't, right? And they stay home and they have very bad health outcomes. And this is really what we're trying to solve. So across the continent, 90% of people don't have any kind of insurance. And that's what we're working to overcome. It's not that there's no insurance companies. So if you look around, you step outside, you can see 10 different insurance company buildings within a mile of here. All of these companies are there, but the companies are focused on the rich, right? They're focused on high net worth individuals, people that are in this room that can afford to pay for kind of minimum $100 a month insurance policies. And that just doesn't work for the majority of people. So that's what we are addressing as Turaco. Our vision is to insure 1 billion people, doubling the number of people insured on the planet. As of today, we launched in Feb 2019. We've insured more than 5 million people across 6 countries. We will reach probably close to 8 million people by the end of this year, and are just growing very, very fast across many markets in Africa. We're in Kenya, Uganda, Nigeria, Ghana, Tanzania, Rwanda, Zambia. We've just expanded into Pakistan. So there's a lot of opportunity. This problem is pretty homogenous across the developing world. People just don't have insurance products. I relate it really similarly to where microfinance was maybe 15, 20 years ago. If you looked at the majority of markets, there were microfinance institutions that were up and coming, but they were kind of donor-backed. The big banks didn't really think that there was a way to make money off of low-income people. Now you have, if you don't have mass market as a part of your focus as a bank, you're missing the biggest opportunity, right? So it's a multi-billion dollar, many billion dollar asset class. We want to do the same thing for insurance. We want to make it obvious that every insurance company needs a strategy. If you're operating in Africa, you have to have a strategy for serving the majority of Africans. The core problem in this is actually distribution. It's not demand. So this is something that we've learned that's been a key unlock for our business. If you talk to those rural families that I was talking about, and you say, "What are you worried about in your life?" They're going to talk about the same things that we have insurance products for. If you then ask them, "Do you want to pay a little bit of money today so that you don't have to worry about those things in the future?" more than half of them are actually going to say yes. And this is proved over and over again through the partnerships that we've launched. It's not a demand side problem. People want to buy insurance. They just don't have the right products designed in the right ways, distributed in the right ways that they can buy today. And so it's really a distribution problem. It's really finding the right ways to connect the supply, which we've figured out how to do at Turaco, to the demand that's already out there. The way that we do that is through partnerships. So we partner with banks, fintechs, MFIs, telecommunications companies to sell to their customers. And that's been the massive unlock for us as a business and how we've managed to get to 5 million customers. The key here is that you've got to design products for the customer, not for the industry that you're in. So I think Radhika is also doing a fantastic job of this, but you have to ignore the playbook, right? So traditional insurance playbook just does not work for the majority of customers that we have. If you ask the customers that we have what product they have, they might not even use the word insurance. They're definitely not going to talk about any terms and conditions. They're going to say, if I get sick and I go to the hospital, Turaco is going to send me 5,000 shillings. That's like the full extent of our terms and conditions. You go spend 2 nights in the hospital, we'll send you 5,000 shillings. That covers the majority of the bill that they would have. And it is designed in such a way that works for the people that we're trying to serve. It was very hard to convince insurance companies when we first started to let us have our full terms and conditions be communicated on 2 text messages. But as you guys are designing, I think this room is mostly builders. As you guys are building, just ignore what everyone is telling you. Like, follow your gut, follow what you know is going to work for customers, and simplify, simplify, simplify. As I said, we scaled across a bunch of markets. We have a ton of learnings about how to do that efficiently and effectively. We've made a lot of mistakes along the way. I think a few mistakes that I'll point at as some of you guys are getting ready to scale across multiple markets is it's just so easy to waste money on stupid things that you find out that you just don't need. So I'll come back to this, like, follow your gut. Don't spend money on expensive people that you think are going to be smarter than you at solving these problems. Just like get into it, figure it out, hire low-cost people that will do the basic things that you need them to do. And once you've figured out, once you've gotten into a market and you're established, then you can scale up a team. It's anti-blitz scaling. It's like more grassroots, more camel rather than unicorn methodologies. But I think for our markets, it's really important to be much more thoughtful about how you do international expansion. It costs us about $30,000 to get a market completely stood up. And we just did another one in Pakistan. Nuts to bolts, it cost us about $30,000 to get the market stood up. I think if I had been trying to do this in the blitz scaling, like pre-ZERP days, I would have been budgeting $300,000 to get a market stood up. So you just don't need to spend money on those things, is kind of the key lesson there. The other thing, and you've heard this from many, many different people, but focus on unit economics and profitability early on. Probably one of the earlier lessons that we learned as a business is it's very hard to be a middleman in any of these markets and make enough margin at enough scale to make the product, to make your business model really work. So we are not the middleman everywhere that we can be. We own the insurance product. It's complicated regulatorily, as others in this room that have taken this approach. It's complicated to get the right kind of license, but it's really the core thing that makes your business work. Right? Our margins went from before we were when we were a middleman, we were making 15, 20% on each policy that we sold, to once we own the product, we're making 50%. It's just a lot easier to make a business model work when you're making a 50% margin. So don't be scared of the regulatory side of things. Do the work, figure out how to do it, and get the license. I've already mentioned like the hard lessons that I wanted to talk about a little bit. Which one is like don't be a middleman. Just to share a little bit more anecdote on that. When we got started and we worked with some very good insurance companies to sell their products, right? We would kind of design the product, we'd go to the insurance company, they'd get it papered up for us, and then we would sell it on their behalf. That process mostly took 12 months, and most of that time was convincing them of what we already knew to be true. If you own the product, right, if you are the person that actually designs the product and owns the product, you don't have to convince anyone. So like, I just will reiterate this. I think for the majority of business models that I saw up here today, the majority of business models that I've seen in the fintech space, if you can avoid being the middleman or the shelf, if you can either all the way own the product or all the way own the customer, that's, I think, the only way to make our business models work in a context where there's not a lot of very free capital flowing until you can get enough scale to make it work the other way. Trusting your gut, I've talked about a lot, so I won't hit that anymore. I think one of the things that almost killed us was, and once again, this is probably common sense, but I tend to trust people a lot. So when we were going through a couple of our investment rounds, and I did this twice, I trusted that the things that were said to me or that the term sheet that was signed was what people were actually going to do at the end of the day. Don't do that. No investor is trustworthy beyond their own specific incentives. And I'm just going to say that full out. And I think that's been true, and some of my investors are in this room, and I love you guys. You've been great supporters to me. But I've had term sheets changed months after going through squeaky clean diligence processes for no reason other than the market changed and someone thought they could get a better deal. Create optionality for yourself in investment as much as possible, and don't put your back against a wall. I mean, it's common sense, but I've lived it. Try not to put your back against a wall. So what's next for us? We are going to do the same thing over and over again as many times as we possibly can. I think there's 2 billion people in the world that need the basic credit life, hospital cash, funeral insurance products that we sell. So we're replicating our model across a bunch of other African markets into Asia. We'll likely be in 3 Asian markets by the end of the year. So we're going to continue to do what we do really well. If you're not talking about AI in like very real ways, you're not going to be investable, and you're also not going to take the opportunity that's in front of you. We want Turaco to be the most AI-centric insurance company on the continent. We have a unique opportunity to do that because we're focused on a consumer base that doesn't have any legacy baggage when it comes to how they interact with insurance. So, I mean, we've already gotten to the point where the majority of our customer communication is being driven by agents. Every aspect of our business has an AI-centric approach. It's going to be very interesting to see what we can do as we take the step from pure micro, low-income consumers into the next layer up of the market and go into more middle market products that we're going to be competing more directly with the big insurance companies for. Because we can sell the same product that they're selling at a fraction of the cost and still make our business model work, because we're using technology in ways that the majority of insurance companies just are not doing. So I think it's going to be very interesting to watch what's happening with us and other players. The nice thing about our model, and I think about a lot of the models that I saw up here, is that they're real businesses. They're not software companies that AI is just going to destroy. I think, note to investors, and you guys are already thinking about this, make sure that there's a real company behind it, not just something that you're going to be able to be knocked out with these tools that we're all using. So that's a little bit about Turaco, a little bit about our story. My last thing is just a shout out to AfricArena. I met our Series A investor at an event in South Africa. I had never met this investor before. We would not have closed our Series A in the way that we did without you guys. So thank you so much for your support and doing events like this. And I know this is very loud. There's construction. You're probably distracted. You're like, why am I here? Is this even valuable? If you're a founder, spend the time, meet the people in this room. You're probably going to find your investor in here. So that's Turaco. Thanks, everyone.
Oh, thank you so much, Ted. Thank you. To build on Ted's success story and to go to the next panel discussion, first of all, if you're happy and you know, clap your hands. Some of us don't look happy, but we're still clapping our hands. That's good. You follow instructions. I don't think you follow instructions per se, but oh well, maybe you're happy inside, right? But let's do it together. If you're happy and you know, clap your hands. If you're happy and you know, clap your hands. If you're happy and you know, and you really want to show, if you're happy and you know, clap your hands. Thank you. So, building on what Ted has talked about, we're going to have a panel discussion that is going to be moderated by Agnes, Managing Partner Fast Circle Capital. So, Agnes, if you're in the room, kindly make your way to the stage. And a round of applause for her as she makes her way to the stage, followed by Thea Sokolowski. Hope I'm saying that right. Head of Marketing and Communications, Stitch. A round of applause for her too. We have Eric Michubu, co-founder Yixi. Also make your way to the stage. And also Florence Githinji, Senior Manager, Strategic Partnerships, Yellow Card. Not forgetting Chuka Ezenwali, Customer Engagement and Portfolio Manager, Silicon Overdrive. You're going to look at how stablecoins is solving Africa's cross-border payment problem. So, a round of applause for the panelists. Thank you. Karibuni sana.
Fantastic. Thank you so much. One more panelist. Yes. Great. Okay, we're complete. Fantastic. So thank you so much, everyone. And thank you for being with me on the panel here. Today we're going to get an insight from very operator-heavy panelists about stablecoins. And I mean, stablecoins have been a big topic over the last 1.5 years. Like, I have seen stablecoin decks left, right, and center. The cross-border payments problem in Africa is big. The big claim, it's expensive, it's slow, and stablecoin is solving all of that, apparently. But there also comes a lot of risks with that, and then there's also some criticism. Is it like kicking the FX ladder basically down, FX can down the road? So we're going to first start off with some individual introductions, and then I'll start with some questions to the panel. Great, thank you. Thea.
Great, hi everyone. My name is Thea, so I lead marketing at a payments infrastructure company called Stitch. But I'm here today because part of the Stitch group is a company called Crisscross. Crisscross does cross-border payments via stablecoin rails, but also via fiat rails. And maybe we'll talk a bit today about why it's necessary to have both. We operate in 20 plus African markets as well as globally. Excited to be here today. Thank you.
Fantastic.
Hello, my name is Eric Michubu, and I'm a co-founder at a company called Yixi. So basically what we do is liquidity provision for stablecoins. We also provide infrastructure for fintechs and companies that want to leverage stablecoins for them to do cross-border payments, or any company that wants to have stablecoins on their balance sheets. Thank you.
Okay. Hi, everybody. Florence from Yellow Card.
Yellowcard is a stablecoin and digital assets provider for emerging markets. We currently are in over 35 countries, majority of those being in Africa. We also have expanded to LATAM as well as Southeast Asia in 2025. So excited to be here to talk about how we're facilitating payments for businesses and financial institutions across emerging markets.
Hi everyone, my name is Chuka. I'm the Customer Engagement and Portfolio Manager of Silicon Overdrive. So Silicon Overdrive precisely, we are AWS partners and IT managed service providers. For me, myself, I'm also a founder of Escrow, which is an escrow system that is built on top of stablecoins, which is precisely solving a problem of immediate remittance, which is one of the problems that most escrow systems have, basically. Nice to be here.
Fantastic, thank you. So now I have a question for each of the panelists. Before we dive into stablecoins, let's first identify what are the biggest challenges you see in cross-border payments.
Okay, cool. So yeah, I think it's not a secret that cross-border payments are very difficult, right? All of the sort of corridors operate very differently. There's different regulation in each market. There's different level of maturity in the payments infrastructure in each market. A lot of these payments can be quite slow. They can be quite expensive. There's a lot of intermediaries that are necessary to enable those payments to flow. And so, coming to stablecoin, kind of the hope is that, okay, here's something that can solve at least part of this challenge, right? And so I think, with cross-border payments in particular, I think something we have to keep in mind is that there's multiple parts of that payment that need to be initiated, right? There's the on-ramping piece, there's the off-ramping piece, all of which involve traditional banks and traditional banking rails. And so within those markets, in order for that to be able to happen efficiently, there needs to be sort of cooperation. And so I think, this is, and we'll get to this, I guess, later with stablecoins, but there's pieces of that can be solved by stablecoins and pieces of that that still need to operate on those traditional rails. And that's where payments companies, I think, come in a lot.
I think on the same, the cost and the speed at which transactions happen across the border is something to be concerned about, because in the traditional rails, there's a lot of intermediaries involved. That takes the fees very high, and that kind of steals or takes a lot of margin before the merchant who is the receiving end gets the value. So stablecoins are solving that problem very easily, simply because it's able to send money directly to the person that is supposed to receive that money, whether it's a merchant or it's an individual or a family member that you're sending the money to. So stablecoins are helping to preserve the value.
To add on to that, I think outside of speed and cost, cross-border payments in Africa just have been, there's a lot of uncertainty around it. You don't know when your money will arrive. You don't know what route it will take. It's very similar to trying to fly from one African city to the other. You almost have to exit the continent to Europe and then fly back into the continent. It's very similar to cross-border payments. It becomes very expensive. There is a lot of complexity that's added to that, and that's what stablecoins are solving for.
I think just one more addition to what I've been said is lack of transparency. Right? You don't know where the money is, who is holding it. You don't really have that view. And that is basically a big problem. And stablecoins tends to solve that as well.
Great, thank you so much. And now for the more established businesses like Stitch and Yellowcard, you've been around before stablecoins emerged. What has changed with stablecoins emerging for you? Maybe you start.
Yellowcard was founded in 2019, or at least that's when we started our operations in the continent, in Nigeria. And what we saw in 2025 was a clear inflection point. We were a B2C company facilitating buying and selling of crypto or digital assets. And then the data in our customer behavior started to change, and we saw about 90% of our transaction volume move completely to stablecoin, whether be it USDT and USDC. And we had to change our business model. So today, we are completely B2B payment company, facilitating purely stablecoins as well as other fiat currencies for businesses. So not only did we change how we operate, it also changed who we are as a business.
Okay. Yeah, so for us, Stitch started also, I guess, 2019, 2020. So we were primarily operating in South Africa as a payments infrastructure player. We serve very large businesses, many of whom operate multinational. So, we want to be the sort of core payments provider for those businesses to solve as many of their payments needs as we can. And so one thing we started to see was, these businesses need to move money into and out of South Africa, but also other markets across the continent. And it's something that they continue to struggle with. So we sort of saw this opportunity to be able to support them with that through stablecoins. So we work with, businesses like Amazon, businesses like Binance that are constantly having to take those sort of local collections that we're enabling within, let's say, the South African market and move them back to headquarters and move them back to Europe, somewhere else on the continent. And that's often very expensive, very slow. So they said to us, is there a way that you can look at helping us with this? And so Crisscross became part of Stitch, I think, around 2022, 2023. And we started facilitating those transactions and then saw just a wider opportunity for us to serve businesses in this way outside of South Africa as well.
Great, thank you. And now I would love to hear your thoughts on stablecoin deployment versus regulatory requirements. Let's start with the entrepreneurs first. And how do you see that as part of your business strategy? Like, what does stablecoin enable you to do, and where do you see you converge with the traditional system?
Okay, so with the emergence of stablecoins, right? I would say it's not a magic wand, so to say, but it sort of gives you that magical power to do a lot of things, right? Back in the days, remittance is quite difficult, right? Especially if you're doing that bridges the gap. For what I've built so far, I can see it's precisely for informal markets. People can now literally buy and sell in the informal market without having the fear of when will I get the money, because I have a stable coin built on the background of it. That was not possible prior to this time, precisely.
So I'll touch on the regulatory question that you asked. So far, looking at the regulation in Africa, it's something that is kind of coming up in most African countries. I know a couple of markets so far have regulatory framework, and the kind of regulatory framework that is coming up in Africa, especially in countries like Kenya, as we have seen with the VASP, it has quite hefty capital requirements that may cripple innovation around the industry. And that is something that needs to be thought out very clearly so that we don't kill local innovators or we don't kill local startups that are innovating around the ecosystem and just promote for multinationals or promote an environment that only multinationals can be able to survive.
Just to add on regulation, I think fintechs have gone ahead and innovated when it comes to digital payments and stablecoins. But I think now we're at a point where we need regulation to be able to scale. So we must look at regulation as an ally if you're going to scale our businesses and our operations and also serve more people, whether it be it in across the continents and beyond. I think the danger with regulation, for fintechs, we are move fast, break things. Regulation can't afford to do that because the cost of getting it wrong and breaking things when it comes to payments is very high. To be able to get customer trust, users need to be able to know that the regulator has thought through everything. So at Yellow Card, we work very closely with regulators. We sit at the table with them and have the conversations that we need to and be able to also educate them on how blockchain works, how fintechs that are operating in this space works. And I think that's what's going to get us to the next level.
Great, thank you.
I think the original question was traditional fiat rails, right?
Yeah.
And stablecoin rails. Yeah. So, also passionate about regulation, but I'd say that's less of my expertise here. So at Crisscross, we kind of have three products that we like to talk about. So we enable local collections, we enable global corporate treasury management, and that sort of FX conversion, and then we enable local payouts because the stablecoin rails are very efficient in, for example, on-ramping, but you still need, again, that local payout and that local payment partner to be able to off-ramp into those local bank accounts. So as an example, if I have someone that wants to trade ZAF, so we do a lot of work in Cameroon, which has quite a sophisticated banking infrastructure. If someone wants to trade ZAF for euros, it's quite easy to on-ramp those euros to USDT. I can, sell that USDT to the person that I want to buy ZAF from, but then that person still has to move that ZAF from their bank account to my ZAF bank account, and then I need to move that money out, right? And that's where we get stuck, and that's what's still taking a lot of time. So while stablecoins are making a part of that process more efficient, there's that other piece that still relies on those traditional rails that is still costly and inefficient, and that's where, from our perspective, we can come in to support from a payouts perspective and a local collections perspective. And I think you need both sides of that to be able to operate efficiently.
Fantastic, great, thank you so much. I mean, that touches well on the FX risks that also come with stablecoins, because that doesn't get eliminated unless everyone keeps paying with stablecoins. And let's keep talking a little bit more about risk. What other risks do you see when you build a business, especially for the entrepreneurs now here? What are the key risks that you have to manage, like building a stablecoin business? And after that, I would love to also hear a bit about what is the benefit of using stablecoins versus not using stablecoins.
I think part of the risks that I've seen within the ecosystem is where a lot of users are not aware of money laundering concerns within the ecosystem. We've encountered a lot of users or clients who receive money in stablecoins, and they're not in a position to check whether the wallet addresses that they're transacting with have been flagged for money laundering concerns. So the customers end up either losing a very substantial amount of money simply because they are not in a position to do the necessary checks for them to identify people or the institutions that they're transacting with, especially from abroad. So that's a very major concern when you're doing stablecoin transactions.
Okay.
I think one of the biggest risks is also bank dependency risk. If banks tend to cut off relationship and you're building on that, it can also pose a serious problem for us that are building in stablecoins as well.
Okay. Okay. And on the side of, I'm curious, on the side of clients, who are your clients, for example? So we give the audience also a bit of a view, what kind of stablecoin beneficiaries there are.
Okay, me?
Yeah, you can continue, and then we continue with Florence.
So, what I've built is, my clients are the informal markets, people that are doing traditional buying and selling. So, not your already set up market. For instance, we have things like Facebook markets in, I think, all over the world. But I mean, in South Africa, it's predominantly what the informal market basically shops on. So now, buying and selling there has been very difficult because of trust. Now, with what I've built, it's quite easy for them to transact, to buy products from that place without worrying about, am I buying something legit? And if I pay, is my money lost? But because of stablecoin, they can buy, literally, confirm the product, are they happy with it? And it gets remitted immediately. They're waiting for 2, 3, 4 days or one month or a week for that money to be transacted.
Okay. Okay, great.
Our customers vary from the largest companies in the world, such as Visa, and also African companies, whether be it SMEs or airlines. This depends on the use cases. So there are businesses that are looking for treasury management, so in different entities across the continent. There are global companies that are based in Africa. They're collecting local currencies and they're looking to repatriate that back to their HQs. There's also a big opportunity that we've seen when it comes to manufacturing, exports, imports sector. And this is where African countries sit in. For example, the African-Asia corridor is quite big for us. Companies looking to make payments for their goods instantly. So those are some of the companies that we're seeing, whether it's be it paying into the continent or collecting funds from the continent.
Before we go on to the next one, I would have a follow-on question here, maybe to also clarify for the audience, why would stablecoins and what's the customer reality like that it makes sense to have a stablecoin-based treasury management, for example?
Let's suppose you're operating in a country like Nigeria, Malawi, Kenya, and have entities in all those 3 countries. So you're collecting Naira, keeping that in bank accounts. You're collecting Kenya shillings, keeping that in bank accounts. We're very aware of the fluctuation that happens with African countries, or currencies rather. So you are exposed to that up and down of, say, for example, the shilling. And also, if you want to move funds from Kenya to your subsidiary in Nigeria, you have to buy dollars. And there is a question of dollar availability in these countries. So it makes moving money very expensive, very hard to even acquire the dollars, but also quite slow. And that's where stablecoins come in. So we'll collect the funds for you, or we'll collect the Naira for you, and we'll pay you in stablecoins rather in Kenya. So it solves a question of liquidity, but also it makes sure that you're not losing money on the FX.
Okay, great. Thank you. And yeah, maybe a different question since we are running short on time soon. But what is like the liquidity advantages that stablecoins bring to you, for example?
Liquidity advantages.
Are there any liquidity advantages?
Yeah, for sure. So with stablecoins, given the nature of stablecoins that they run on blockchain, and it's not reliant on very traditional rates whereby you will need to go through a central clearinghouse like a central bank, for example, or a reserve bank, you are able to move money at almost the speed, almost instant. You are able to do transactions at almost instant kind of transactions. Even on weekends, you don't have to wait for days or for hours for approvals to happen, simply because the blockchain transactions are almost instant or near instant kind of transactions. So when it comes to pulling liquidity, it's something that is quite easy for you to manage. And in as much as you may be having operations in multiple countries, if there is demand for sure, maybe in one certain region, you are able to pull the liquidity in that region and be able to service your client quite efficiently.
Okay. And I mean, just quickly, on that point, I mean, stablecoins, we mostly buy US dollar-based stablecoins. When you buy US dollar-based stablecoins, can you buy them with, let's say, Kenyan shillings, or do you have to convert to USD first?
For sure, you can go from almost any African local currency to USD-pegged stablecoins.
Okay, so you convert at that point?
Yes, exactly, okay. Instantly.
Great, thank you. Yeah, maybe let's talk a bit about what do you think there needs to happen for stablecoins to scale across Africa?
Yeah,
scale better. Let's put it like that.
I mean, I think regulation is definitely one thing. I know this gets talked about a lot, but it's true. I mean, it's very difficult when you're uncertain in one market to another, what you're allowed to do, what you're not allowed to do. There's a lot of gray area, right? And so, like, the sooner we're able to kind of operate with more clarity, the better. I think also there needs to be payment partners in all of those local countries in which we're operating that are able to manage, as I've talked about, the on-ramp and the off-ramp piece, right? So until that's possible, we're still going to face that kind of sticking point and that challenge at those points, right, within those markets. So, if I want to move money between Kenya and Tanzania, I can do that. For example, on the if you think about a payment, there's two sides of a payment, or two things that need to move, right? There's a data piece, which is, banks talking to each other, talking to networks, and that today is able to move very quickly. But with stablecoins, there's a sort of promise that the money part of that transaction is able to move as quickly as the data piece. And while that can happen on, the currency conversion part of that transaction, it can't happen at the other end. And so I think a combination of regulation, modernizing and digitizing those payment rails within each local market, and then kind of cooperation amongst those markets where that money is trying to move to enable that to happen is important.
Fantastic, thank you. I would love to get each of your opinion also on where do you see African governments heading towards regulatory frameworks, and is that a risk that you feel like, okay, I don't know how to manage it, or like how do you manage it actually? Let's start with Chuku. Yes, please. Since you were laughing, let's start with you.
I'd rather he starts because it's good.
Like, how do you look at the regulators? What are your expectations towards the different African regulators?
Okay. One thing that I would like to see the regulators in Africa do is harmonize the regulations, or at least have a way of unifying the kind of regulations that they are coming up with, so that at least once you are licensed in one market, it's easy for you to get licensed in another market, simply because the kind of operation of the customer you are servicing is almost the same. The infrastructure or the kind of offering in different African markets may be different, but actually the kind of customer that you are servicing is the same. We have the kind of same problems in Africa, whereby our currencies devalue over time. We have inflation the same way. We do business almost the same way. Yes, the market may be different, but even having the ability of, let's say, license passporting is something that I would like to see the regulators do, simply because you get a license, or you acquire a license in one African market. When you go to another market, you have to start from scratch, and it's not something that is very interesting. It's also very quite costly to do all these procedures. So harmonizing that kind of licensing is something that I would like to see the regulator be able to come with.
Is it my turn now? Okay,
I think kind of want to refuse the question, right? Like you're trying to.
It's sort of a very tricky question, basically. But I think what the government can actually do to improve stablecoin and to make it a mass in Africa is possibly to start backing or making the local currencies adopt stablecoins. Like, instead of pegging it against USDT all the time, or for instance, Kenyan shillings having their own stablecoin backed as well. That is one part. And also marrying, how would I say it? Enabling the bank to actually adopt the stablecoins that are compliant, basically. So, because the banks have not actually joined in the game at the moment. I think that will enable the...
Great.
From what I see.
And maybe to add on to what they've both said, I think regulators and governments need to focus more on the ease of doing business for fintechs and institutions that are operating at stablecoins industry. And today, even though in Kenya, for example, we're very advanced when it comes to regulation, it's still very hard to go and open a bank account, right? And to scale, we do need distribution. We need payout partners or paying partners. And those are banks, they're telcos. So the government needs to get to a place where they're focused on how can we empower businesses to run effectively. And I think there is a lot of momentum that's happening, but speed is also going to be a key thing that regulators need to think about.
Okay.
I'll offer maybe a slightly different perspective. So taking South Africa as an example, I think they've made a ton of progress on the regulation side recently. So there's something called PEMs, the Payments Ecosystem Modernization Program that the South African Revenue Bureau has initiated. And one thing that's great about this is they're actually taking the power for the first time away from banks in terms of who gets a say as to what innovation gets to go to market. So now for the first time, innovators, perhaps stablecoin companies, fintechs can work directly with the regulators to get the approvals that they need to operate in the market. So this is a huge barrier that's been, or in the process of being removed, which is super exciting. At the same time, South Africa has really, really strict exchange controls. So now there's a sort of question opening up of, okay, well, there's control over when fiat currencies move in and out of the country. Is this now gonna be in place for when stablecoins move in and out of the country, and what does that look like? And is that actually going to then inhibit and slow the process for these transactions, which kind of defeats the purpose, right, of using this rail? So it's these sort of dichotomies even within one market that we're seeing, and they have to sort of, figure out what that's going to look like there. But I think it's a good blueprint for some other markets to start to look at in terms of what's possible from a regulation perspective.
Okay, fantastic. Great. Thank you so much. Is there anything else what you want to add?
Yeah, I think where it pertains to businesses or emerging businesses or startup, I think government should actually establish regulatory sandboxes so in order to test out and to experiment, because there are no sandboxes like that, and it's quite expensive. So I think that is also very, very key if we actually want stablecoin to gain more in Africa, precisely.
Okay, great. At that point, let's see if there are any questions from the audience. Yes, please. Have somebody to...
This is to Chuka. There is an epistemic gap in terms of incommensurability and market co-creation. The target mostly is the general population. And let me not use the word poor, but we come from low-resourced regions. So how are we going to ensure that everybody's hands are on deck? Because that way, it makes business sense. When many people have the knowledge and the know-how of the entire fintech system, then the uptake becomes high. So it makes business sense. But mostly when we meet in places like this, we are preaching to the converted, but there are lots of people out there who probably will not be able to get this. So how do we ensure that we co-create solutions so that there is higher uptake?
I'm not sure I got the question, though. Did anybody get it? It's very... sorry.
Short, I'm
Can you
saying,
break it down
what is your take on market co-creation? Like in stakeholder engagement.
Do you have an answer to that?
So do you mean like market co-creation? In what sense market co-creation?
What I mean is this, the good products that you are talking in the space, in the fintech space. Of course, the people who are developing it are business people, and they want to make money, but maybe the people who are being targeted have no idea. Like you talked about government regulation. People will not stop innovating just because the regulation is not in place. So how do we involve these people from the word go, so that when the product is out there, then there are no regulatory issues, for example?
I think that is already happening in a way, because when you look at the current businesses actually represented here is Yellow Card has been in the market for close to almost 10 years now, and there has not been regulatory framework in place. We've been in the market for about 3 years now. There's not been a regulatory framework around in the industry. In actually some of the market regulation is not a conversation that they are having or they don't have any framework around it already. It's now that they're formulating those legal frameworks to be able to support stablecoins and blockchain businesses. So that is something that has already been going on. So maybe how can we make sure that there's more visibility to the people who need our solutions? So with regulation now coming in the picture, it's easy for us now to market publicly and to go after the kind of target customers with ease, with no restrictions as there has been in the past. I hope I answered the question.
Great. Any other questions? Can we get them like...
Hi. So a bit of an outsider, but active observer. So I'm kind of curious, with the Pan-African payment settlement system available in like 13 countries and nearly like over 20 pretty soon, do you see the stablecoin systems being able to effectively like compete with that more bank-oriented system, or will it just continue to operate in parallel effect?
We couldn't hear you.
You didn't hear me?
Yeah. You're very quiet.
I'm really loud to myself.
No.
Okay. All right. So the Pan-African payment, payment and settlement system currently supports like 13 countries with banks across that and over 20 pretty soon. Do you see stablecoin systems like competing with that, or effectively, like it's more of a bank-based system, or do you think the stablecoin system approach will continue to operate in parallel?
You want to go first?
I mean, I think both are necessary, right? So besides the off and on-ramp piece, I think we're also seeing a lot of enterprise businesses are choosing to still use fiat rails to send those international payments, right? There's a number of reasons why it might make sense. One example being, if you have a purchaser buying something from you in another market, they are choosing to operate on fiat rails, right? You have no choice over that. No matter how sophisticated your sort of stablecoin infrastructure is, you still have to be able to receive that payment from them, right? So I think, and then also, like I talked about with the exchange controls in South Africa as an example, operationally, it's very complex to be able to kind of operate within that ecosystem through stablecoin transactions, right? It like actually takes a lot of onus on the company that's making that transaction. And so for them, it actually just makes sense and is faster, easier, and cheaper to do that on fiat rails. So there's a number of use cases as to why it still makes sense to use like the SWIFT system, for example, versus stablecoins. And then there's a number of reasons why it would make sense to make a transaction via stablecoin. So I think for the foreseeable future, they will continue to operate kind of side by side. And then obviously there's the on and off ramp piece, which is continuing to be very important there.
Great. Do you have anything else to add?
To add something on that is, we are seeing a lot of interest even in the traditional banks to want to have stable coins as part of their infrastructure, especially to power cross-border payments. So given that the existing rails to power cross-border payments is quite slow and costly, I think for local operations, a lot of institutions are still going to stick to the local fiat currencies, but where cross-border payments is concerned, they're going to have to adopt stable coins in a way.
Great, thank you. Any other questions? No? Okay, let me go back to my panel. Is there anything else that you would like the audience to know? Or you're finished?
I guess one thing that we've been thinking about that I think is kind of cool is, this idea of what like a full life cycle of a stablecoin can look like. So because we're also a payments provider, we can, for example, enable someone to actually get paid in stablecoin to their stablecoin wallet, and then use that directly to pay for things in their day-to-day life. And I think particularly in markets where their currency is quite volatile, it's something we're seeing a lot more demand for. So I can give an example of like a company like Deal, right, that pays a lot of workers in multiple markets. especially in Africa, that worker can choose to be paid in stablecoin, and then we can enable them to, for example, pay for their Spotify subscription or their Netflix subscription directly with stablecoin without having to first convert it into local currency. They can also choose to then convert it into local currency, which we can support with, or they can maybe invest it right through their wallet, through crypto wallet. So I think that is something we'll start to see a lot more of. There's even some companies, again, for example, in South Africa, Pick and Pay is allowing people to make payments for groceries in person using crypto, right? So again, you don't even have to go through that layer of converting to that local currency. So I think there's a lot more interesting use cases other than just like enterprise cross-border payments that we can think of for this, and especially in these markets where the local currency is quite volatile.
Just to add on what she just said is we have built a wallet as a service infrastructure whereby any enterprise that is thinking of having stablecoins in their balance sheets can be able to offer wallet services like to their end users, as well as virtual Visa cards that accept stablecoins. And these Visa cards are accepted in every market that Visa or MasterCard is able to process transactions. So there's no need for you to actually have your users off from stablecoins directly into local currencies. They can be able to utilize stablecoins directly from their virtual Visa cards with no need of a framping at all.
Great. Yes.
I think two things. One is stablecoins have proven product market fit, and any business, regardless of size, needs to be thinking about what's our stablecoin strategy. I really like the question around is stablecoin necessarily competing with, say, for example, banks? I don't think so. At Yellow Card, for example, we've built an enterprise-grade infrastructure that banks just need to take our infrastructure, integrate into their existing rails, and they are good to go. They don't need to figure out the tech. They don't need to figure out the compliance part of it. All of that, as Yellow Card, we've done for you. So we think it's going to be a partnership between traditional finance or payments partners and stablecoin or fintechs. The second thing is the real reason why stablecoins are working in Africa, it's because, and emerging markets, it's because cross-border payments has been happening in the continent way before stablecoins arrived. It's just that as Africans, we kind of got to a place where we were comfortable with things as they are, as difficult as they are, with the weight. But today as a business, you don't have to do that. You can talk to businesses like any that's represented here, and that solves a lot more problems for you, but also improves your efficiency when it comes to running your business.
I think they've all said the most important things, but I think I just have to say it loud that stablecoins are not replacing banks, precisely. They're enforcing financial efficiency, right? And I think banks should be willing to stop defending their inefficiency and be willing to evolve. And that's the only time, trade can be more efficient. And when trade becomes more efficient, economies grow. And when the economy grows, life becomes a lot more better. Thank you.
Thank you so much, everyone. And thank you for this very pro-stablecoin panel. I think since we're very operator heavy here, that was to be expected. So I'll thank everyone and leave it at the note. The only risk that we will see as of today is probably dollarizing all our economies and governments losing control over their monetary policy, which we should keep in mind as we build this out. That might lead to some significant regulatory backlash. Okay, well, thank you everyone so much, and I wish you great continuous program.
Thank you.
Kindly don't leave. We have a group photo. Agnes.
Mira, no, dale, camera, no, fata, moca, no, mọ́ra bébí ó kì í ṣe máa nà ọmọ pẹ́ ti gbéra gan. Yẹ kí n máa gbélé jù, Mr. Money mo wà available. Ibi my cross náà gbélébù, èmi máa gbé dé bẹ̀bí kó kàdá. Deliver stay banana.
Thank you so much. A round of applause for them as they sit down. And with that, they're going to usher in us into our next session. Okay, fine. So, can we all, and it's still a bit cold, so we can stand a little bit and stretch before we get to our next session. We've had to adapt a little bit, but all in all, we should be going for lunch in a few. So let's stand up a little bit. You remember the additions that we did sometime in the morning? So we were adding 1 plus 1 equals 2, 2 plus 2 equals 4, 4 plus 4 equals 8. How many of us remember that? Yeah? So, okay, I want us to do that again, and then we can do a bit of a dance session to just energize a bit. So can we all stand kindly? Thank you. So, I need someone to help me do it. So can you come to the front? My bright student. You know, bright students sit at the front. So, okay, fine. We're going to do 1, the 1 plus 1. 1 plus 1. Was this one really? Was this one? No, this was 2. This was 2, okay. So let's go over. This is 1. This is 2. This is 4. Okay? So 1, you're going to show the rest of the students. 1 is this one. This is plus. So 1 plus 1 equals 2. Yeah. So are you okay now? So 2 equals. Can I have another volunteer? Any volunteer? My bright student has failed me. Anyone else? Yeah, you're being volunteered. Anyone else? You want to mean no one got the moves? Okay, let's do it on my own then. So it was 1. Let's do it together. 1 plus 1 equals 2. 2 plus 2 equals 4. So 4, you cross your leg like that, okay? And then 4 equals 8. Are we now at par? Can we do it together? Okay, fine. 1 plus 1 equals 2. 2 plus 2 equals 4. 4 was this. Plus 4 equals 8. Thank you, thank you. Thank you so much. We're going to have just one keynote speech, and then we're going to break for lunch. And that is Built in Africa, Backed by the World. A keynote speech on that, the anatomy of a fintech breakout. And with that, I'm going to invite our keynote speaker. Just gonna go through the names quickly. I'm going to invite Agnes. I think I got that wrong.
I can introduce myself, no problem.
I'm going to invite Caroline on stage. So a round of applause for Caroline as she comes to the stage to give us a keynote on Built in Africa, backed by the world. Welcome.
Hi, everybody. I'm so happy to be here. I'm in very impressive company. My name is Carolyn Honeveman, and I'm the Managing Director for Paystack Kenya. I'm going to have to keep looking back. Okay, there we go. So if you haven't heard of Paystack, we're one of the fastest growing fintechs on the continent. We operate in multiple countries, and we serve over 300,000 businesses since we started. Now, I think our founder, Shola, would be one of the first people to tell you that if over 5 years ago you had told someone that two undergraduate engineers from a Nigerian university with no real VC connections, no formal finance background, would sell their payments company to one of the biggest fintechs in the world, Stripe, for $200 million, I don't think a lot of people would believe you. But that's exactly what happened. And I think what's most exciting is what has happened next. And that's why I'm here on stage today. So since the acquisition, we've grown over 12-fold. We process more than 12 times our payments volume. And most importantly, and I think the biggest milestone for us, is that we reached profitability. Took us 10 years, but we reached a very big milestone last year. It's a bit of a lag, sorry. Okay. So going back to our story, and I think we see our journey in three main phases. Phase one started with Shola and Ezra, our founders. They joined Y Combinator in 2016. They were the first Nigerian company to get into YC. After that, they got a seed funding of $1.3 million, followed by Series A of $8 million, which ended up in an acquisition by Stripe 5 years in. The first 5 years was really about building product market fit in one market, making sure that we got traction and we were solving a real problem in Nigeria before we decided to scale. The second phase is when I joined Paystack, the phase of expanding and ensuring operational excellence. That's where we built a company that ultimately got to profitability. We grew 12-fold, as I mentioned. We expanded across 5 different countries. We took our time to go really deep in the markets that we were in. And I'll share more about why and why trust and reliability is a big component of that. But I think the next phase is really where we're most excited about. So recently, we announced that we've broken out into a new holding company structure called the Stack Group, which is now co-owned by Stripe, our founder Shola, as well as the employees. And so this next phase for us, where we think we're going to reach escape velocity, going beyond payments, building a cross-border company, a banking company, and a consumer payments company built on the foundation that we've been building for the last 10 years, and having employees that have their own stake in that. And I'm here today to share why we're so excited about the fintech space and why we're so excited about the opportunity that exists in Africa today. I'll share what I think makes up a breakout fintech. We'll share also a little bit about our learnings for how to attract global capital, and then ultimately some of the takeaways for navigating what is a very complex space to be building a business in. So why fintech and why fintech in Africa? I think a lot of things have been said earlier today, but the story previously has been a lot more about potential. So what we think could be on the continent, and I think we're living in a reality where the opportunity is actually here and it's actually happening right now. In 2020, we saw digital transaction across the continent be around 800 billion. We're at over 2 trillion today. And at the end of the day, financial services and fintech powers everything. It powers the entire economy. You can't build anything on top if you don't have the fundamental infrastructure to move money. And it's still not easy. That infrastructure exists at a very, very different place today than it did 5-10 years ago, but it's still being built. You can't build any sector that isn't built on top of fintech. I think what's also very interesting, there's a very interesting space for aggregators, still like Paystack, because the payments methods and the trend is that payments continues to be fragmented. Most of the Western world, payments converge into cards. That's not what we're seeing here. It continues to be fragmented into the different types of consumer payments. In Nigeria, for example, 5 years ago, 90% of what we processed were cards. Today, that's less than 50%. It's mostly bank transfers. So there's a real need for aggregating and building on top of what is a very fragmented payment space. The mobile, I think another big, we talked about, in order to access digital transactions, your mobile phone is your portal to that. And we're seeing the mobile adoption across the continent is not a potential, it's here. We've also seen that has driven a lot of the innovation around mobile money. So we live in the country of mobile money innovation, of M-Pesa. 74% of mobile money transactions worldwide is done on the continent. And still, what's very interesting, it's a fact that I learned a couple of weeks ago, is that 75% of transactions here in Kenya are still done in cash. Still, in one of the most digital transaction-forward country of M-Pesa, 75% of money is still being transacted in cash. So still lots of opportunity to come. I think the second force that really drives the opportunity here is the massive demographic shift. I'm sure you've already heard some of these numbers, but 1 out of 3 people, young people in the world, will be African by 2050. That's a massive force. And the infrastructure to support that demographic is still being built. Every single one of those young people are going to need to move money, save money, invest money, and build companies. And in sub-Saharan Africa, that means over the next 25 years, you're adding 600 million people to the working population. Again, that infrastructure is still being built. And then lastly, I think the third force, which we all talked about, and what we talk about is the industrial revolution of fintech is happening right now. And that's that convergence between stablecoin and blockchain technology and AI. Stablecoin, as we just learned on the panel, is very, very real. I think the solid example is JuicyWay, which is a Nigerian created fintech. They've already moved $1.3 billion in cross-border payments via stablecoin. It's not the future, it is happening right now. Around 40 to 50% of code right now is also being generated by AI. GitHub, I think, is 46% of code being merged into GitHub right now is generated by AI. That's a massive opportunity to change your unit economics of your business and to move much faster. And so I have never been more excited than to be in the fintech space, especially because fintech is ultimately the product that you're building as software. It's not as easy as that. It's built on relationship, it's built on Rails and all of these things, but you're not moving physical goods. And I think that's the power of fintech, is the ability to scale because it's a technology that you're building. And the opportunities here now, what does it take to actually capitalize on that opportunity? Because it's not easy to build a company, and a company that scales and makes it. So I think there's 4 main things. The first one is probably very obvious, but first one is around solving a very big problem. When Shola started Paystack in Nigeria, he was not thinking about how to build a breakout fintech or how to scale a fintech. He was trying to solve a problem for himself. Payments in Nigeria was really, really, really hard. It was unnecessarily complex. He figured out how to charge a card on his computer and was like, oh, wow, this is what can be done. I can make this so much simpler for myself, for consumers, and for businesses. And that's how we started. You can't make it big if you're not solving something that is a sizable problem for people, that solves an everyday friction. Not a niche kind of inconvenience, but an everyday friction. That's how you build something that can actually scale. A way to actually shift the way that businesses and consumers behave. Here in Kenya, yes, it's been a very innovative market because of the digitization via M-Pesa, but the problem still exists. It's still difficult for consumers to pay. It's still difficult for businesses to accept money and to move money. And so there's a real problem to solve in everyday transaction that allows you build economies and businesses on top of that. Next. Trust is everything in fintech. Because at the end of the day, it's people's money. It's their livelihood. You won't get anywhere if you don't build trust. And trust in a currency is your reliability becomes your product. And that's one of the main reasons why we've chosen to go deep. We've chosen to focus on reliability and redundancy and to focus on customer support. So anecdotes, in Nigeria, that we've been around for 10 years, we have over 18 bank partners at this point. If you swipe a card, there are 5 to 6 different ways for that card to be successful. You have to build redundancy into everything. Here in Kenya, we were licensed in 2022. We have over 4 bank partners. There's at least 3 ways for a card to be able to be successful. And we're continuing to build that redundancy because we know that at any point there could be a failure because we build on top of banks, we build on top of rails. One of the biggest things is also to get closer to those rails and to get closer to the infrastructure that moves money. Now, trust isn't only reliability of your product. It's how you show up in everyday meetings, with your customers, with your banks, with your regulators. I think we talk a lot about, at Paystack, when we talk about different risks that we're willing to take, I would say we're probably more on the risk-averse side. And the thing for us is that we've always said to ourselves, we don't cross the line, but we move the line. So if there's an opportunity where we know we can blatantly be crossing a line and breaking a rule, we will say no. Because we're trying to build a multi-generational infrastructure company across the continent. It's not about quick wins. It's not about taking the dollar today, because we want to be able to take dollars tomorrow. And so when we engage with regulators, and for sure, we've gotten our hands slapped. I'm not going to say we haven't broken rules. But I think there is a trust with regulators and with our partners that our intent is there. Our intent is to do the right thing, but we know that we can't just accept the line for where it is. We have to work with our partners to move it. And that's where the trust comes in as well. Third is The third ingredient I would say is like being able to scale, but scale with local context. And a few companies have talked about this today already. Fortunately, in order to reach scale on the continent, you have to cross different markets. In order to be able to really get a sizable opportunity and get an addressable market that makes sense for what you're trying to do, you have to expand into multiple markets. And every market is very, very different, as most folks know here as well. Regulators are different, currencies are different, the way consumers pay are different. And so being able to strike the balance of what you centralize and what you do locally is as much of an art as it is a science. I joined Paysac 5 years ago. The first 3 years, I joined as a product leader, building our Pan-African platform that basically worked to abstract the things that were common across markets that allowed us move faster and scale. And then the next 2 years, I've worked on how do we localize that for the Kenya market. Some of the things are very, very obvious, like ensuring you're paying through M-Pesa, integrating with PesaLink, local bank partners, and so on. But even card payments here that fundamentally work the same in Nigeria as it does in South Africa, as it does in Kenya. Every implementation has its local nuances. The partnerships you have to actually create to build those rails and those APIs, they take time. Some of our core banking partner relationships that we've had, it's taken 3 years for us to onboard with them and to integrate. And it's a work worth doing, but it requires you to show up at the door of these banks almost every day and go knocking to make sure you get onboarded. And so one of the things that I've focused a lot on and fought a lot for, is making sure that I have an autonomous cross-functional team here in Kenya that can move fast. Making sure we have product development teams here in Kenya that can meet the demands of our businesses quickly, having a business operations lead that can be knocking on those banking partners' doors, and making sure we scale with local partners, making sure we have local customer support agents, making sure that we also have local legal representation. Now, I wouldn't say go heavy from day one. I think it only takes us, we had maybe 2 team members here in Kenya for the first 2 years as we were building a product. And a lot of other things were done centrally. At some point, though, when we realize we've gone from 0 to 1, and you think about what you really want to scale the business, that's when you start investing in a team. And we're still, I would say, investing in our go-to-market team. It's a thing that we have deprioritized to keep us lean and making sure that we're building a product that works. And then lastly, I would say is the only way you scale is like a great company is by hiring really great people. And the leaders is what matters most here because they are the ones that set the pace. So the very first person, the founder, they're the one that's going to set the pace for your company. They're the one that is going to have to reinvent themselves at every stage of your company to get to the next one. And one of the things you also have to think about is that, and what Shola has been very good at, is he's recognized what he can and cannot do, and he wants to hire people that are constantly better than him. Doesn't mean you have to pay for a really expensive team of leaders to succeed. But you do need to hire people that have really good judgment, that know how to find good talent and to nurture them, and to ensure operational excellence in your business as you're looking to scale. All of this is great. These are all great ingredients, but we wouldn't be able here if we hadn't attracted capital to give us the time and space to learn, fail, and grow. And we were able to do that with the investments that we got early on and via Stripe. And so going back to our original story, so Shola, as I mentioned, Shola and Ezra got into Y Combinator in 2016. They met quite a few investors during that time. And then in February 2018, so 2 years later, Michael Siebel, who's a partner at Y Combinator, he reached out to Shola and said, can I make you an introduction to Patrick Collison, the founder of Stripe? I think you can learn a lot from him. Absolutely. He makes an introductory email. Patrick, meet Shola. Shola, meet Patrick. And it was Patrick that picked up the next email. And he said, hey, nice to meet you, Shola. I've heard great things. Let me know the next time you're in San Francisco, and we'll grab a coffee and have lunch. And Shola responds, I'm in San Francisco this week. Can we meet on Thursday? Great. Shola goes and buys a ticket, flies to San Francisco from Lagos, and shows up. And so they sit at Stripe office. This is February 2018. And they basically Patrick is also an engineer, like Shola, so they're geeking out on APIs, they're geeking out on each other's dashboards. I think Patrick was impressed that even though there's a lot of things that are similar across our companies, that we had also built Paystack from first principles based on the context of the continent. And at some point during the conversation, he turns to Shola and says, so when Stripe goes to Africa, what are you going to do when Paystack stops existing? Because that had happened. Stripe had entered, I think it was Japan, and the local payments system, the local Paystack there, had stopped existing. And Shola was completely unfazed. He's like, there's no way. You're not going to succeed in Africa. Because here, it's so relationship driven, and you have to have such local context that you're not going to be able to just go in and take market share. And then the next, and part of that was also he said, you have to get to know each of the major banks. We basically built, on the side of GTB Bank, we built their integration in order to be able to integrate with us. I know all my key customers. I'm unfazed. The next day, he got a WhatsApp message from Patrick that said, hey, would you be open to an investment from Stripe? And that's how that relationship started. Our lawyers said, it's good to get a few other folks on the cap table. So then we also reached out to Visa and Tencent, and that was a strategic round. Stripe it was probably a one-page term sheet with extremely founder-friendly terms, which doesn't happen as often today. And I've heard that from a lot of founders today, is that the term sheets are getting less and less founder-friendly. So please, it's a plea for all investors. And so we raised $8 million, and that was the relationship that then started, that led ultimately to the acquisition, which was more of a strategic play for both us. We hadn't run out of money yet, but felt like it was a great way to incubate our idea under the umbrella of Stripe. And for Stripe, they didn't have any presence in Africa. So for them, it was, do we go in ourselves, or do we buy something that we've already invested in? And a part of the due diligence of them buying Stripe was actually sending a team to South Africa to see, can we do this ourselves? And the answer was no, because you need local context. And so, everyone is going to have their own stories for how they meet their investors and what is their exit story, how it all plays out. But I think some of the lessons to take away is, first, you need access to those global, for the global strategics and also global VCs. Y Combinator was a great platform for Paystack to start getting access to those global players. The first check into Paystack after the YC demo is actually a Japanese investor. And this is why AfricArena exists, right? This is why we're here, to connect on both sides. I think the second is relatability. And it's very easy, I think, for someone like Patrick to understand what Stripe for Africa means. But it's easy to explain. We're building Stripe for Africa. And it was the same thing I saw with Ndovu's pitch. BlackRock for Africa. It's a very relatable story for any global investors that understand what BlackRock and Stripe is. And following that up with, why wouldn't Stripe directly succeed on the continent? What's needed for them to be able to expand? And how can you complement a strategic player like Stripe or a strategic player like BlackRock? BlackRock would not be able to make it the same way here, as I know Ndovu is doing. And then lastly, I think every language that crosses, the language that crosses every boundary is basically numbers, right? Measurable traction. And it's gotten a lot more rigorous over the last few years around understanding your unit economics, being able to prove not only selling a vision, but also proving it with evidence. So revenue, retention, volumes. And I think what's really exciting today is that your unit economics are drastically different with AI. And that's what's, I think we're entering into a very, very exciting next phase because of that. At the end of the day, though, we know that it's really hard. It's hard to raise capital. There's not enough capital to meet. That's like, I think, is proportional to the opportunity that exists here. It's a hard continent to operate in. And I think, it's hard to build a company anywhere. I think building a company in Africa has its own unique flavor of hard. You have inflation, devaluation of currencies, macroeconomic shocks that have an outsized impact on the continent. So it's a tough space to operate in. But I would say like the one trait that is the same across the board for any company that makes it here is resilience. So how do you build in resilience to everything that you do and all the parts of your business? So I'll just mention very quickly the things that we do to build resilience into the company. The very first thing is like co-building with regulators. So regulators change policies a lot. Have to make friends with them. They're not your adversaries. They also have a really tough job, to be honest, regulating in this space. And so, working and making regulators your partner is so key. The second one is diversifying your business. So, we were in Nigeria. The Naira devalued massively from the time that we started to today. It's very imperative for us to be able to expand into new markets, but also be able to collect new currencies. So really diversifying away from the Naira was a big focus for us as well. I think the third one is around people. So we're in a very relationship-driven, very people-first market and place. It's something that we also pride ourselves in, that we focus on people. But you have to build systems that outlast any one person. At this point, Paystack, I would say, is bigger than any one person, and that also includes Shola. People come and go. I remember, we were so afraid when one of our most senior talented engineers, Femi, who you might know, who started at Chowdeck, when he left Paystack, we're like, oh my God, what's going to happen when something goes wrong? And I think that was a first test 5 years ago that it's okay. We're going to be okay. And I think, as we grow, as people leave, as people come, building the systems that are going to outlive any one person is really important. And then lastly, just make the hard calls before you're forced to. And this, generally, hard calls has to do with people, so changing people, letting go of people. And in 2023, I think we were looking at our unit economics and they weren't making sense. We had probably 30+% of our employees were outside of our core markets, being paid in USD. And it didn't make sense. Our Naira had devalued. The unit economics weren't making sense. So we had to do a restructure. And basically, a lot of the employees that were outside of our core markets were let go. It was a really hard decision, but it was also something that set us up for success. And so I think as I just leave this stage, I think we're really, really proud of the journey that we've had so far over the last 10 years. We're just scratching the surface. I think the most exciting phase is yet to come. I think fintech is also not a zero-sum game. The more people that are building in fintech, the greater the infrastructure becomes, and we're all going to grow the pie together. But there's an opportunity here, and it's basically who is going to grab that opportunity, and is it going to be you? Are you going to be that breakout company? Are you going to be the one that solves a really big problem, that builds trust before you need it, that hires the right people, that's going to raise your standards? If all of these things are true, you're absolutely positioned to build a breakout company, and Africa is for sure the place to be. And I really, really, really hope you succeed, and that we all succeed. Thank you.
Thank you so much, Caroline. Caroline was standing between us and lunch, and she really did a good job, right? So let's give her another round of applause. Thank you, Caroline, for those valuable insights on building solutions. That was very insightful. Now, before we break for lunch, I'd just like to remind you a few things. For those of us who didn't get their name badges, kindly just go to the registration desk and you'll get your name badge. And also, as we break for the lunch, we have a spinning wheel right here. So you can just come and try your luck, because there are prizes to be won once you spin the wheel. It's an interactive game during the lunch hour. And our lunch is going to take 90 minutes. So from now, let's count 90 minutes. That's around what time? Around 3. Right? So yeah, we have plenty of options around the vicinity or also downstairs. You can just go and find something to bite real quick, and also engage with our spinning wheel right here for a chance to get goodies. So see you at 3 p.m. It has been nice. And make sure you also visit AfricArena.com to connect with people online and to make sure that you are in conversations.
Salete fetsa bjang le sotho.
currency. They sometimes need settlements within a foreign account. That's what we can offer. Just to make sure and to explain that there's a huge difference in multi-currency processing. In certain cases, many payment providers can accept USD into a local bank account, for instance, a Kenyan shilling account. But to accept USD to USD, that sometimes gets difficult because you need a US entity or you need a US bank account somewhere, and that's where we come in. Through partnerships, we make that possible. So we do both. We can do settle locally and we can settle cross-border. And that is, if you understand the travel and tourism space, that is crucial. So this is some of the verticals, and then of course on the e-commerce side, we've got your usual plugins that goes along with online payments and payment pages. Just from a South African perspective, we know it works. The reason why we know it works is these are some of the establishments that we work with. So in the hotel space, we work with one of the biggest hotel chains in South Africa. They've got over 32 properties. Some of the properties included in and Mauritius. So we know we've got the solution that works. It's now just to duplicate that across Africa. And that's where the problem comes in, because as you know, it's fragmented and it's not the same everywhere. Regulations, banking, fees, settlements, methods. I can name it. I can be here all day. But that is the main reason. So that's why we leverage partnerships as far as possible. So just some of the guys we work with from a South African perspective. Okay, so like I said, payments, it's not rocket science, but there is method to the madness. So with us, we try and make it as seamless as possible. So it's basically collection, processing, settlement, making it quicker, faster, more effective. So yeah, that's basically what I said. We can see that one. So what makes PayGenius a bit different as well is that we are development friendly. So we are a company first. So we try and integrate and adopt our systems to make it customized to your industry or your business, because not every business use case is the same. You might use the same systems, but you might want to display it in a different way. So that's where we come in. We can make our payment structures flexible. We do that. So custom work is part of it. If it makes sense for us, we will do it because we are in the industry. We want to make the industry grow and prosper across the globe. So part of that would be our integrations. Some of the integrations that we work with or integrated partners at the bottom there, I know it's a bit grey, but as you can see, it's some of the big names within the industry. It's players like Checkfront, Profit Room, Semper, Hotelier, ProTel is global as well. And then we're also busy working with Opera as a PMS partner. This is some of the multiple payment methods that we spoke about. For us, we try and add as many methods as possible. So this keeps on adding changes as we go, as we enter jurisdictions, as the new requirements. Like for instance, today there was a mention of stablecoin. That's definitely something we're looking at in the future, how to incorporate that into our current structures, just to improve the whole payment flow as a whole. From a disbursement or distribution perspective, sending payment links and making it easy to send from a small SME to your big multinational hotel chains, we try and make sure that we stick to what is working with the users. So for us, a new feature that launches our WhatsApp feature. That just makes it easier because everyone in here, I believe, is on WhatsApp or some type of messaging platform. So now we make it accessible and easy for a merchant to send a payment link via WhatsApp, collect the payment via WhatsApp, users get notified, everybody knows that payment's collected. So you can do this on the go. You don't need to sit in front of a computer, you don't need to be plugged in. You can create a payment link on your cell phone, collect payment in USD, Euro, whatever payment method you want that we integrate with, and your business can keep on growing as you go.
Thank you. A round of applause. Another round of applause for him. Thank you so much, Vizel. And that opens the forum for the next exciting session, where we're going to have our next pre-seed pitch track number 2. This session, we have Amos Gashiri, Investment Associate, Impact Investing, and BD Coma Capital. A round of applause for him. Karibu sana. We also have Steve Mwangangi, Investment Professional, 7 Capital Ventures. Karibu sana. We have Amarachi Nwachukwu, Venture Partner, Africa and Portfolio Support, MAL. I hope I'm going to say this right. LVC. Are you in the house? Amarachi. Okay. And then we have Vizel Combri, you were just around here, Head of Sales and Business Development, Pay Genius. So a round of applause for beautiful panel, or our beautiful panel of judges. So moving on, we're going to look at the startups that are going to pitch today. And if you could help us on the screen on our first startup. Remember, for the startups, we have only 5 minutes to pitch, 2 minutes for questions. So, first we have Rafford. So, a representative of Rafford, kindly, you can make your way to the stage. A round of applause for him. 5 minutes to pitch. And we'll have the timer on our screens.
My name is Anton Mayodi. I'm the co-founder of Rafford Limited. So Rafford Limited is a fintech company that provides financial services to unbanked and underbanked clients in Kenya. So which problem are we solving? Number 1 is financial barriers. Number 2, we're also in financing access to renewable energy products. Number 3, we are also financing smallholder farmers. Market opportunities. There's a big market in Kenya, especially for small and micro enterprises, because currently you go to the banking sector, they have shifted completely. They don't finance this sector because the government is borrowing a lot from the banks. So they see this sector to be very risky. So we are left in this market. And that's why we are serving that market. Our solutions, we provide finance, that's to micro, small, and medium enterprises. And then also we provide capacity building. So we don't only give them money. We train them on how they can grow their business to move from micro to small to medium to grow to big companies. On the technology side, mostly when we started financing access to solar systems or renewable energy, we started with solar. We went to energy savings cook stove. Now we have gone to financing actually productive use. So we are financing all those rounds. The reason why we went to renewable energy is because these products are expensive, and in rural areas also, people don't have cash money to buy this product directly. So that's why we went to that area. Market the market in Kenya is big, although a lot of We have a lot of fintech and a lot of financial sectors in Kenya, but the market we are serving is still big, which we cannot actually manage to serve. And as a company, we are looking at how do we scale. Currently, we are working in 13 counties in Kenya, but we want to cover the whole country. And then maybe in the future, we expand to East Africa first, before going somewhere else. But currently, we are just working in Kenya, and that's what we are building to grow. So I think I've already explained this. I'll move from that one. Our customer profile, as I said, micro, small businesses, smallholder farmers, and then technology. We actually diverged a bit to go to finance small cooperatives in rural areas, which collect milk from farmers, and then they keep that milk, grow up to a certain volume, then they sell them to the processing company. So in the rural areas, you'll find that electricity is very expensive. So what we are doing is we go to the cooperative, we finance them to install solar systems to cool the milk so that the milk does not get spoiled. Because sometimes when the power goes home, it can go even for 1 week, and then the milk gets spoiled. So that's the technology also we have gone to. Horticulture, we are looking, what we are doing is we finance actually small groups of farmers to grow horticulture crops to supply in the markets near them. And what we do is provide, we help them to acquire solar irrigation pumps so that they can continue even plow even during seasons when there's no rain. And then also the dryers to dry those horticulture so that they can sell them even for a longer period. How many minutes? We have competitors in the market. We have them Coppers, Sunculture. Actually, Sunculture, they're not competitors because sometimes we buy from them, then we finance to our customers. Then we have finance institution, traditional, and the digital lenders. Financial projection. We are growing institution. That's why we are looking for funding so that we can expand more. Currently, Rafford is profitable. So our team, I'm the founder and the managing director. We have Florence, she's the chief finance officer. We have Elizabeth, she's the operation officer.
All right.
Then Sylvia, she's the HR manager.
Time is up.
Thank you.
Yeah, thank you for that. So just one quick question. At the start, you mentioned that traditional financiers don't cater to this customer segment. How exactly do you de-risk this financing for this customer segment?
Repeat the question.
So at the start, you mentioned that traditional financiers don't cater to this specific customer segment. Yes. So how does your business de-risk financing this customer segment?
First of all, we don't just give them finance because we want to grow with them. We have been open for the last over nearly 7 years. 8. So you will find that they started with 10,000. Currently, they are taking 3 million, 2 million, 1 million. So we have grown with them. So that's the difference between us and fintech and other organizations. So we grow with our client to make sure that we support them to grow. Yes.
Okay. We would like to understand your traction. Yes, how many customers do you have currently? And also the solar asset, do you own it or do you partner with solar providers?
Currently, we are working with over 14,000 clients. Our income 2024 was around 340,000 US dollars. The solar, what we do is we partner with manufacturers and distributors these products. But we make sure that these products are also certified by Verasol so that they are of good quality. And then we enter into agreement that if there's any issue, they will come and support. Yes, customers.
Okay, thank you very much for your time. A round of applause for him. Now, on to our next startup. We have Nuclex. Nuclex. A round of applause for them as they make their way to the stage. Remember, presentation is only 5 minutes, and the 5 minutes is on the screen.
Good afternoon, everyone. Hey, can I hear something? Good afternoon, everyone.
Good afternoon.
Fantastic. Right, this is my first time to be on the stage for a pitch, so please be gentle. So I'm going to walk you through exactly what Nuclex is. And first of all, before we get started, 2 seconds. Oh, no. Right. So, what's going on? Right. So, to start with the problem, I want to give a personal account, right? Because I come from Kinshasa, DRC, and I've noticed something. It's when I booked my ticket to come to Kenya, it's borders, right? I didn't have to worry about visa or anything. I just got it. So that's one thing. The second thing is I went to the Bureau de Change to change my CDF to Kenyan shilling, and they say there's no liquidity. And that itself, it's literally console for Nuclex. Borderless transactions, borderless settlements. And I want to go through the numbers. There are a lot of numbers here. As you can see from Congo, it's literally the last, we've got Nigeria. They also experience the same problem. Government experience debt servicing that's running because it's in US dollar, right? Local currency depreciate, and people turn into solutions such as stablecoin. As you can see the numbers here, currency depreciation in Nigeria, dollar access is a problem. South Africa has a corporate treasury in stablecoins. You've got Kenya for mobile money and P2P and remittance to families, Ghana as well, retail, inflation hedging, and so on with Ethiopia. Now DRC actually adopts mobile money. That actually comes from here, M-Pesa, Airtel Money, and Orange Money. And moving on, actually, since I come from the DRC, I want to raise the problem with what's going on right now. There's less than 1 year to make cash USD transaction in the DRC. And that's the central bank governor statement. He mandated. So banks, wherever they come from, they've got to comply to it. So you can only make transactions in US dollar electronically. And this is where Nuclex intervened. And I also mentioned that underbanked people in the DRC, 85 million people. And that's a lot of potential. There's a lot where that come from. Moving on. The solution Nuclex has, it's a B2B financial infrastructure. Think of a cross-border settlement between businesses that actually Africa demands. Piloting in the DRC, expanding to countries such as Kenya borderless, so it will be probably the first target. And it starts with the consumer USDC wallet, which we have right now. Right? It's moving to a merchant SaaS, but they talked about many different solutions for payments. That includes methods of payment, and they use enterprise-grade APIs for big companies. So we're moving from a consumer wallet to a merchant SaaS, right? So you accept USDC by QR, payment links, auto checkout, and so on. Then, the niche that we have right here, mining settlement layer, you may ask why we added settlement. Nuclex is actually registered with the National Commerce. We have a niche, which we move to right now, where there's an issue with traceability, which goes upstream for identification for contracting miners, and it goes all the way to payment, because a lot of people use cash. As you can see right here, there's a consumer wallet. I'm just going to walk you through it. It's just an app, basically. You log in with your mobile number. It could be WhatsApp, Telegram, voice, OTP, and it's easy to be. Someone mentioned about PayPal earlier. So make sure on the front end, people are familiar with such as PayPal, Venmo, I come from Gonzo, Revolut, actually. That's basically, as you can see your balance, you get to see your transaction history, you get to your cards as well, you get to mobile money and banks. And moving into the dashboard right here that you see here, that's the total settlement, basically, with the dashboard for merchants. They get to see transactions, they get to see the subscriptions, they get links, then sell they do in stablecoins. They get to see all the checkout conversion they have, right? Move it non-activity. This is how it exposes the payment gap. As I mentioned, we target Africa. We have with the issue, government issue with debt servicing, right? And in terms of value on-chain with stablecoin, you get, in sub-Saharan Africa alone, in June 2025, you get 200 million. So that goes with Nigeria, South Africa adoption. Great work they've done so far with ASP license. With the SAM, right, we've got the DRC, 100 million people potential. We've got people adopting mobile money. We've got remittances that go up to $2 billion US. And the sum, this is the part where NucleX has the leverage because we register with the chamber, is the mining sector. You've got a supply chain that has an issue with disability from the miners up to international exporter. Upstream, you've got an issue with identification of subcontractor and the fact that 98% of transactions are made in cash. This is where we intervene. The chamber accounts literally counts on us to actually solve that issue since cash US dollar will be illegal next year, April. Moving on, you've got the 6 revenue streams that we have. It's long-term goal. That's a long-term shot. That's a slingshot, basically. In 3 years, with the company that's literally in the middle of links, which is the EGC, the General Enterprise Company. Oh, I guess my time I just ran out. So I'm just going to quickly go through, I guess, that traction, all you VCs need. We are literally pre-revenue, right? Beta testers so far, we cannot operate because REC framework in Congo doesn't promote, are not favorable for startups, especially with technical, that's a solution such as blockchain. We've got testers, we've got the partners, Kotani Pay, that's based actually in Kenya. We've got Milestone in Nigeria as well. And we've got the team ready to build the SaaS. As you can see, this is the license that's being applied 26th of Feb. And the roadmap shows like this. And I just have to close it. Sorry I took the time. It's a long project. It's the first time. And I would like to say thanks to you all for listening to this pitch. Thank you.
Here we go, 2 minutes, great. And thanks, good pitch, well done. Being in the payment space, I just have a couple of questions. Firstly, what does your revenue model look like? How are you planning to make money?
I plan to make money through subscription to a SaaS, actually. For SMEs, piloting in Congo, since the nation to the supply chain of mining industry. You get that integrate with the partners, because I've got MOUs with the chamber, actually. I've got pressure on that.
Okay, and what does the percentages look like? What is it per month? Payments?
Payments is subscription, basically.
Yeah.
Since they integrate, we think about years, like in 600K in 3 years. It could happen quicker because of the hurdles you have with the regulatory, especially in the mining sector. That's pretty much it.
And then, sorry guys, second question, last. In terms of liquidity, are you going to cross that gap because you're going to run into that problem? And then on and off ramping, what is your plan there?
Kotani Pay is a startup here. They've asked me if you need anything about on-ramps, off-ramps, and deposit withdrawals. How much do you need? I said, we got the mining industry 10 to 20 million literally volume of transactions. So I've got that pressure on that side, but they say they can get that covered.
Okay, so you've thought about it. Okay, great. Thanks.
Okay, great speech, and
Thank you.
I'm a big fan of stable coins. So I want to understand how you want to navigate the regulation.
How I navigated that regulations? Well, the reason that's why I'm here is I've already made application through lawyers. Well, I'll just avoid the legal part, but that's important. To operate, I want to align with the regulations since cash USD transaction will be forbidden next year. Is to make sure to operate, because at any level, consumer level, even testing, to enterprise, I need to be regulated. And it requires $200,000. Just itself to have yearly accounts of your capital requirement. And I'm not even talking about the fees that you have to pay to acquire it.
All right. Time is up. Thank you very much for your time and presentation. So, on to our next startup, Safari Bucks. If you can make your way to the stage, a round of applause for him. Remember, the time on the clock is 5 minutes and 2 minutes for the questions.
Yo, 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 yo. So, good afternoon, everyone. So, I've got an incentive for the room. I'm actually giving out free money today. So, for the first 10 customers that sign up to Safari Bucks, we'll get 300 shillings on their application for me. So, that's the first 10 customers, okay? So, what is Safari Bucks? So Safari Bucks is an interoperable wallet that's solving the problem across East Africa. So whilst East Africa is very mobile money dominant, unfortunately that problem stops at the border. So whilst you have people who cross the border, money doesn't. And that's the problem that we're trying to solve. So businesses that are operating in Kenya, Uganda, Tanzania, they face this problem 10 times greater, because unfortunately Africa is fragmented, and that's the key problem, and that's what we're trying to solve. So the way that they manage this is through cash floats, juggling SIM cards, fragmented FX workflows, all which cause cash leakages for businesses. So there's no real-time visibility, and there's no unified financial control. And the biggest companies that face this problem is logistics. So when you look at the logistics market across Africa, just at the Malaba crossing, there's 2,000 trucks that cross daily between Kenya and Uganda. And drivers typically carry per diems in cash or M-Pesa. And they cross the border, and when they cross the border, they have to find an M-Pesa agent on the other side or MTN agent. And they have to ask that agent to do a physical transfer of cash, and they send their money on M-Pesa. So this typically accounts for about 5-10% FX losses, and border FX is about 10 to 20% worse than you find at the local market rate. So, and again, when it comes to eTIMS in Kenya, which has recently launched, if you're spending around 200,000 Kenyan shillings to get your goods from point A to point B, you face the problem of how do you demonstrate to the Kenya Revenue Authority that you actually spent 200,000 when you only have 100,000 worth of ETR receipts. So KRA doesn't care. They're going to turn around and say to you, we're only going to account 100,000 for the KRA, for the ETR, and we're going to tax you at 30% on the rest, which is a big problem for logistics companies. So there's huge tax penalties when it comes to Kenyan logistics companies, and there's a lot of fraud and massive leakages in this space, so due to manual handling of cash and M-Pesa. So essentially what we've built is one cross-border wallet for Kenya, Uganda, and Tanzania. And I urge all of you today to sign up and load your money. You can load from either card, M-Pesa, or through bank. In Europe, we've launched with open banking. In America, we've done ACH pool. So if you're a Kenyan, you can actually load money from your M-Pesa. You get an STK push. The money goes into your Safari Bucks wallet, as you can see there. And then you have the same rails as if you had MTN in Uganda, Airtel, Tigo in Tanzania, Vodacom. So essentially, you can buy goods, pay bill, same way that an M-Pesa user. So virtual M-Pesa. And for the businesses, what we've built on top of that is a corporate dashboard. So the way it works is that a corporate company can load their money into our platform, which is what we call the corporate funding wallet. And from there, they can create sub-wallets for each of their employees. So they have per diems, so you can add your employee and then give them, let's say, 10,000 shillings, and then from there you have the ability to make use of that money. So the biggest current payment rails and the challenges are cash, as we know, high risk, high fraud, M-Pesa Global, high FX margins, and the other option is traditional remittance routes, very high FX costs, and delays in timing and settlement. This is a quick example of M-Pesa Global. On your right, you can see an M-Pesa Global user who was trying to send 40,000 to Uganda from his M-Pesa in Kenya. M-Pesa doesn't actually charge you transaction fee, but where they sting you is on the FX rate. So you can see for that 40,000 transaction to go through, the user was being charged an approximate 4,000. So for every 10,000 shillings you send, you're being charged 1,000 shillings. Compare that to Safari Bucks, where that same 40,000 transaction, we are only charging 1,200. So you can see the difference in massive savings. So how Safari Bucks works is essentially, as I said, business funds the Safari Bucks wallet. The finance team set rules and policies about how they can spend that money. And then the driver has the ability to make payments across borders as if they had a local mobile money network rail. And then they can also do instant reconciliation across their financial systems. So whether that's on QuickBooks or Zoho, they can export systems into reports. So essentially what we're trying to do is reduce cash leakage, reduce FX losses, avoid ETIMS penalties, improve driver safety because they're not carrying cash, and real-time visibility on how that money is actually being spent, and also for audits as well. So making financial officers' lives easier. So why now? When we look at the size of Africa, East Africa's mobile money market and cross-border market is increasing and it's growing day by day. As I said before...
Time is up. You're eating into your question time. So you only have 1 minute for a question.
Can we restart the question timer, please?
Well, he ate into it, so just 1 minute.
Okay. Just a quick question. So you mentioned your primary market is already mobile money dependent. So could you walk me through your distribution strategy?
Sure. So essentially we ride on a number of different banks. So in Kenya we partner with Choice Bank. In Uganda we partner with Laken. And in Tanzania we partnered with Tembo Plus. So essentially what we can do is we have floats that sit in each of those different jurisdictions, and you load your money, but you can spend from, essentially, we're ordering those payments for you from your wallet. So it rides on all mobile network operators. So if you're making a payment to a Safaricom line, or if you're making a payment to an Airtel line, it just works as if you had M-Pesa in your pocket, or Airtel in Tanzania.
So what's your ask?
Okay.
My ask, in terms of how much we're raising, we're looking to raise 200,000 US dollars at this stage for 10% equity.
Traction?
So we have, we've got two use cases, as I mentioned. This is the logistics use case, but we also have the tourism and traveler use case, and that's actually a partnership we're doing with the Kenyan government. There's more traction in terms of the number of users. We've got about 150 users who have used the platform, processed about 5 million Kenya shillings. But in terms of the logistics use case, we've got about 6 customers in pilot at the moment. And these are logistics firms, your consulting firms, and a law firm that we're onboarding currently.
Thank you very much for your time. Thank you. Now on to our next startup, and kindly let's make sure that we keep time. So Nest is up next. A round of applause for her. 5 minutes on the clock for the presentation. Make sure you don't eat into your questions time.
Hello. Okay, so hello everyone. My name is Evelyn Ongoi and I'm the founder of Nest. So Nest is our financial identity infra, which we're building for informal businesses around Kenya. Right now we are piloting in Kenya and we are targeting a market of almost 1 billion plus businesses which are informal. Their data are not visible to the formal life. Like most of the banks cannot access this financial data. Okay, so the problem, these people who we call informal businesses have real revenue. Think of chamas, think of kiosks, think of that hotel outside your house, think of that mama mboga outside your house, this mama mboga you go to every day to get maybe skuma wiki or something like that. So, but the problem is they don't have structured proof, like they don't have any bank statement, they cannot they cannot trace their M-Pesa transactions. So what you are doing in Nest, we are enabling these people to be able to track these information. So how we get to prove the missing information, this credit. So we have our AI agent called Manika. So Manika, think of Manika as your AI CFO. Manika runs your business. You see how Zoho stroke QuickBooks works? Now, Manika is running everything automated, and we collect this data that Manika runs, and we turn it into a credit form. It's a digital provable information. And we call it tokenization if you want to know. And okay, so after running these, your cash flow, everything, the information that you have, maybe the bank that received your money, and every information, any financial information, any cash that comes in, you see your stocks that comes in, everything. Just think of how you run your business. Every single information. We have it on our dashboard, and we turn into a token, and we are able to share with lenders, maybe in case you want any financial assistance. And okay. Okay, so how we earn money, our AI CFO, which is what the business people are interacting with, you pay 300 per month. Now, these are the, if you just have like one branch, you pay 300, and if it's a multi-branch, you pay 600 plus. And for the banks that you are giving APIs, they pay for the API and a small amount of every loan that is successful. Okay, so, okay, I already shared about our target customers, and the credit gap is 5 trillion plus. We are focusing on fixing that. Okay, so our information, we get it from the behavior of the business, and yeah, I don't think I'm missing anything else. So yeah. And my name is Evelyn Ongoi, and I've been running business for the last 6 years, so like, I have experienced that.
First question is, how are you addressing the culture challenge where informal businesses don't want to go put their records online in any way?
Actually, she asked me, I think yesterday, the same question. Okay, so, no, it was Kezia, not you. So what we're doing right now, I'm going shop to shop, talking to them, and I don't think there is a big culture they are not willing to change, because most of the people are putting these statements on their books. Even right now, I just acquired like 2 customers just talking about them. They put this information on their books. I don't think there is any rigid culture that making people not want to change. They don't have they just don't have the system to change, or if they want to change, the POS system that they are offering nowadays is hardware. Not everyone can afford hardware. And at the same time, not everyone can afford hiring a CFO. Yeah.
All right, so can you walk me through how Monica works? I mean, the agents, is it on WhatsApp? Do you have a mobile app? Then secondly, can you also walk me through your team? Who are the people building this, your experience? Do you have a technical co-founder?
Yes. Okay, I'll start with the team. I'm the technical founder, and I'm also the business strategy. So like, the co-founder that is coming in, they're just coming on the strategy side. So I'm building it. So, and to address how Monica works, Claude gave me that. So Monica, when you open your application, you're able to list your stock. You see, and every time whatever you sell, let me assume you have like hardware. Maybe you sell something like, what do they sell in their hardware? Maybe a chair, 2 chairs. And then it will list the amount of, you will list the amount of money this chair costs, and you see the total. And then Monica will be able to tell you the profit that you made, and maybe even the loss that you made, and even the stock that you will take. Monica is able to track that and tell you, this is the amount of money you used for stocking. This is the profit you are supposed to get. And if you get any loss, you'll be alerted. And for people, for people who have multi-branch, maybe they have cashiers, Monica will be able to tell them this cashier is losing money or something like that. Yeah, I hope you understand.
For banks, this segment of the market is higher risk than usually they'd go to. So in terms of de-risking for them, have you thought of anything else apart from the KYC aspect that you're speaking on?
You see, we are giving them real-time data, like financial data, not just KYC. They are able to connect to their customers directly from our platform. We give them our APIs. They are able to access the customer's data from the first thing the customer put to the last.
So let me understand, probably I did not understand. Does that mean then the customer sales go through your platform?
Yeah, true. We actually generate a QR code for every receipt, everything sold, in a QR code form, not like a paper-wise. You can just scan and see everything that was being sold, and everything is updated daily.
Okay. Thank you very much. A round of applause for her. And on that note, Safari Bucks had an announcement to make that if you'd want to sign up and for the free money, kindly visit www.starbucks.co.ke www.starbucks.com. Okay? But he's going to come and tell us later. It's like, I didn't get that quite clearly. So, our next startup is Investor. So, Investor, kindly make your way to the stage. A round of applause for him. 5 minutes on the clock for your presentation.
Hello, everyone. My name is Moses Liach. I'm the CEO and co-founder of Investor Farm. Back in 2020, when COVID-19 hit Africa, just like so many people, I lost my job. I went into farming and applied for a loan. And after a long, complicated process, I got rejected. My story is shared across by 80% of 60 million farmers across Africa who were not able to access these finances due to a number of different reasons. And that is why we started Investor Farm. So what do we do? For Kamau and Atieno, all they have to do is create a profile on our platform, complete our KYC, and receive embedded financing in form of loan vouchers. They redeem these loan vouchers for climate-resilient inputs across agricultural stores that we work with. We mostly target women and youth farmers. Why? Because women pay loans. Number two, they make 70% of the entire agricultural workforce. Our ticket sizes generally range from 100 to 500,000 Kenyan shillings. We provide insurance to cover for droughts and floods. So how do we get the money to finance the different farmers? Now this is where it becomes interesting. We list the different farms as IPOs on our platform. Then we have investors buying and selling shares, just like you do on a stock exchange market, based on a particular crop. So from what you can see on your screen, we have coffee, maize, and different farms listed on the platform. So these prices would depend on different market conditions, either yield increase or weather conditions or different factors. Why are we doing this? When we started, we were a P2P lending platform. We realized farming is not a one-way of lending system where you give farmers during planting and then you leave them to God and the government during the rest of the time. We decided to provide a value chain approach towards financing. So this method enables us to finance during planting, during growing, and during harvesting. So maybe just to cover, so the agri-financing space is growing to 180 billion according to FSD by 2030. We do not just want to be a team player in this space. We want to be a leader by financing the next 100,000 farmers with close to $100 million in the next 5 years. How do we plan to do it? So this is my team. We are made up of individuals who've worked with leading banking institutions. Myself, I've been an entrepreneur for quite some time now. And we have a team of advisors that have helped us grow this company to what it is. We started back in 2023. We're still growing much stronger. So we want to be the JP Morgan Chase Bank of Africa. So far, we financed 10,200 farmers with up to 4.8 million USD. We incorporated in the UK and Kenya. We are working with 300 agricultural stores and cooperatives across the country. We've raised 150K in venture and grant funding. We've won different awards, and you can check us out on social media. So these are the different stakeholders and partners that support us across the country. We're raising 750. Why? We're going to use this for licensing. Right now, we're working on a partner's license, a partner's CMA license. We're also looking to convert about 100,000 farmers for the next farm financing, and we're also looking to further build our product. Thank you so much. Join me as we help farmers get access to capital.
Okay. So you mentioned that part of the use of funds would be licensing, and
yes.
You're using a partner license.
Yes.
So I just wanted to understand your licensing posture in Kenya. What specific license are you going for, and just the specific details on how much you'll need to have for that?
Yes. So we work like a stocks exchange in the sense that we list farms, and then investors can buy into the different farms or sell. So for instance, if Steve is going to buy into a coffee farm, let's say the farmer needed $1,000. The farms are divided into 100 shares and sold at 10 each. So Steve can sell his shares during a mid-term or after a full cycle of farming, depending on how much interest you're going to earn. So that aspect makes us require a CMA license. So that's why we would need that type of license in regards to that.
What specific CMA license?
So basically the buying and selling of shares.
Great, thanks. I just have a question on the stock prices. Who determines and what determines the stock price that's listed?
So how we determine the stock price is, number one, is based on the price of a commodity in the market, so the market demand. Number two is on weather conditions that are available. And then number three is also at the stage. So for instance, a crop that's at early stage, the price in the market is different from a crop that's much more in the older stage. So it depends. So we have a primary market and we have a secondary market. The primary market is when the investors invest directly into the farms. The secondary market are now the buyers and sellers buying from other investors. Yes. And we also provide liquidity when there's a dead market as well.
And is that benchmarked against something, or is it just...
Pardon?
Is it benchmarked against a certain standard? I don't know, agriculture is...
So we have a base revenue. Base revenue comes from the interest that we get from our farmers, roughly between 10 to 15%. And then we have a yield that generally comes from the increase in price of the different crops.
Explain to me once I have sold a share of my farm, how do I use those funds? As the farmer, are you guys leasing the land? That mechanism, how is that working?
Okay, so with the farmer, we are providing it in form of a loan. So you're at the farmer, you need $1,000, you come to us, you complete KYC, you list there from the KYC, you need $1,000. Now from our end is when we do the stocks. So we list you 1,000 shares on the stocks exchange markets. And then there are $1,000 as in form of shares. So it would be $100 at 10 shillings each. So if an investor comes and buys the 100 shares at 10 shillings each, he would have provided you with the $1,000 that you need. But remember, we do not give loans in form of capital. We provide embedded finance. So we do input financing. So at the end of the day, we'll provide you with different inputs that you'll redeem from the partner stores.
Okay. So for the investors that buy shares on the farmers' portfolio, have anyone been paid out so far?
Yes. So we have different ways in which investors can get their money back. So like I said, we have the primary market. If you invest in the primary market, we have both the full cycle and the mid-cycle. The mid-cycle is when, let's say, you invested and you want your money back. We can provide your money back between 30 to 60 days. For a full cycle, it goes between 3 to 6 months, depending on the type of crop. So you roughly earn between 15 to 25% based on the particular crop and how well it did in the market. But there is a base revenue that you earn regardless of whether or not that crop, its yield actually increased.
Okay, thank you very much. A round of applause for him. That marks the end of the pitching. Thank you also to our panel of judges. A round of applause for them too. And it opens a session for our next speech. That is from David Biama, Sales Manager, Vato. Karibu sana to the stage, Bwana David Biama.
Good afternoon. Is everybody in a good mood? I mean, after the pitches, it's been quite fascinating for the afternoon. And I'll just take this up. I think this would be a better position to stand. Now, my name is Biama David. I'm with Vato, actually one of the sponsors today and definitely tomorrow. So what I'm actually looking at, even before I start off, is how many of us here have played a game of poker? Poker, anyone? Great. So that actually gives me my opening line, whereby Vato actually started off from a game of poker. How is this? Our founders, that is Ola and Anthony, well, they were back in London, of a casual game of poker and just having conversation on how difficult it is for Anthony at that time to actually send money to Nigeria. And with Anthony being the current, is founder and CTO, he was more like, I mean, with the ideas that Ola has and with the tech background that he does have, why not combine and come up with something that will make it easier for African migrants to actually send money across border and back to their families? I mean, and that's actually how Vato actually began. And for us, it's more of unleashing the power of cross-border payments infrastructure. Okay, so what I'll actually talk about here is just a cross-border payment, because previously Vato was actually known as an FX partner, but that has since actually evolved into cross-border payments. So if you're actually looking at your pay-ins, payouts, FX control, which is of course part of a part and core of our business, it's our bread and butter, this is actually the place to go. If you look at just the numbers of the global payments that we've actually processed, when I talk about from a simple poker game, if we look at last year, did close to $15 billion of global processed payments. This is actually what a leapfrog growth looks like. And that hasn't been easy. I mean, just looking at the number of currencies that you could actually trade in. Right now we're looking at 50 plus, and you can actually currently concept your payments in over 190 countries across the world. Of course, due to some restrictions of countries that you cannot trade with, we abide by these laws because we are FCA approved, licensed by the FCA at the UK. So basically countries that are under sanction, that's not something that we could actually touch with a 6-foot pole. Now, founders, what were they actually looking at? If you recall what I spoke about in terms of having delayed payments, local payment rails that actually require local knowledge, high cost of exchange, lack of visibility of where your money is. I mean, you've sent money on and it's actually taking T+5 for you to be settled, looking at different traditional banking systems whereby you have no clue where the hopes are, which intermediaries actually, your money is actually going through, and the liquidity challenges. So basically looking at the common cross-border challenges, that's where VATO comes in. And with VATO, you are in a position to have all these 6 pillars that I've spoken about solved and sorted out at a drop of a hat. Just looking at, let's say, the countries that you could actually do business with. I mean, you could be in Nigeria and having a very lucrative business of let's say, cosmetics in the East African market. So thing is, for you, you don't actually need to come to Kenya to have a locally domiciled local account. What we VATO actually allow for you is to open up a local account, like here in Kenya, but not necessarily going through the requirements. So that means is you could actually get paid in Kenya shillings into your wallet account and receive that in real time. What you're talking about is T+0 when it comes to settlement. Or you're having a business in Ghana and trading with someone in Botswana. So you actually get to open a Ghanaian local account and do your trade across the divide. Or even looking at it from a global perspective, you're having your suppliers in the United States, so maybe the UK or Canada, you could actually have a global account that you get paid into. And what does this actually do? It gets rid of the FX amounts that actually come in, the costs that are there. You understand how doing business cross-border, which has actually been spoken about by a lot of individuals earlier during the day, it actually beat that. So you don't need to worry about waiting for money to be in your wallet on a timeline of 5 days. I mean, within 5 days, there are a lot of cash flow issues that you would have actually come through. And the thing is, you want your cash flow to be predictable. You know that if money has actually been paid to you, within T+0, you're actually settled. You free out your operations. Guys at Treasury are able to look into matters that are dear to your organization. I mean, if you're in, let's say, insurance, if you're in trade, like some of the business that have actually been spoken here and pitched, farming, and you're doing imports or exports to the various parts of the world, you want your settlement to be instant. You want to be certain about your payments, and at the end of the day, you know exactly what amount you're receiving, and not some opaqueness that current systems, or let's say traditional banking systems, actually had. Now, I've actually just spoken about the local accounts and global accounts. Now, the beauty about the global accounts is that you can actually send and receive with over 150 countries. Spoke about 190. So basically, I don't think that's actually doing business with nobody in the world, with the exception of the sanctioned countries. But apart from that, you're able to actually do business with anybody, anywhere within the world. Maybe perhaps next we'll be looking at the guys at Artemis who are going to the moon, but that's for future growth. Now, with that, I'll just actually just say that with what I've spoken about is Vato actually makes cross-border transactions as simple as sending a text message. You know how a text message is? You're quite sure, unless the network issues or maybe downtime on some telecommunication sales, you're certain that the instant you've actually typed a text message and you've sent it, the end receiver has it. That's actually how Vato does with your cross-border transactions. Now, right now, I couldn't actually just deep dive more onto, let's say, your specific business use case, but myself and the team, we're actually here. We do have a beautiful desk that has been set up for us. We could actually just drop in and have further conversations with us on this. Thank you so much for your time. Enjoy the rest of your evening. Bye-bye.
Thank you so much for being precise. Now we have one more session where we are going to have a panel discussion. I'd really, really want the technical team to help me put the chairs on the stage. And with that, we're going to have a panel discussion on from potential to performance, the path to exit in fintech for Africa. And our moderator for the day is going to be Jessica Hope, founder and CEO, Wimbat. So Jessica Hope, kindly make your way to the stage, and a round of applause for her. We have Apollo, the country manager, Luno, Kenya. A round of applause for him too. He's one of the panelists. Not forgetting Dario, who's the founder and managing director, Brita. He's also part of the panelists. Alvaro, the principal, Speed Invest, is also in the house and also among the panelists. And last but not least, we have Jaziel, who is the Africa Investment Officer, Akion Ventures. A round of applause for all our panelists, and let's sit according to how our faces and names appear on the screen. Yeah.
Good evening. My name is Imran, I'm free from my demons. I'm so bored in them, I call him, my father's the reason. I play for a lot of boys, but I left in the season. My therapist said to me, bro, how you keeping? How you eating? How you sleeping? How do you cope when they leave when you're not even beefing? I don't care about the pain as long as we're pleasing.
Thank you so much, Diana. Can everyone hear me? Fantastic. Okay, congratulations to all of those people who got up and pitched earlier on today. It is not easy. It's nerve-wracking doing these things. People are so passionate about their business, and then getting up and talking about your business and trying to raise money in front of strangers is nerve-wracking. So round of applause, please, for all of those people that got up and pitched. So hands up here. Has anyone exited a company yet? Well done. Congratulations, Christoph. So we'll be happy to have some questions from you. But this session is going to be about the path to exit, in particular in fintech. We talk about it a lot. It's a hot topic of conversation this week in Nairobi. We're all looking for a liquidity event of sorts in life, right? So we have a fantastic panel here today to run us through some ideas and some pointers and advice on what a fintech exit might look like. I'm going to ask my fellow panelists to introduce themselves very briefly.
30 seconds maximum, please, gents, so we can get into the discussion. Jasil, we'll start with you, please.
Hello. Okay. Everyone, my name is Jazeel. I am the African Investment Officer for Axion Ventures. We are an early-stage investor investing in fintech companies across global emerging markets, and I lead the business here in Africa. We're writing checks anywhere from $500,000 to $1 million into pre-seed to pre-Series A fintech companies. But yeah, this is a bit about me. I'll talk some more after this.
Thank you very much. Dario?
My name is Dario. I run a company called Brighter. We're a business intelligence company focused on what we call underserved markets. It's great to be here. Thanks, Christoph and team, for inviting.
Thank you very much. Alvaro?
Hi, everyone. Pleasure to meet. I'm Alvaro. I'm a principal at Speedinvest. We are a Europe, Middle East, and Africa fund, early stage, with around 1.5 billion in assets under management, and have done a fair amount on the continent and looking to do a lot more.
Thank you very much. Apollo?
Apollo Sunday, country manager at Luno, global crypto platform.
Wow, very concise. Thank you, Apollo. And just in case I haven't met you, my name is Jessica Hope. I run Wimbart, a PR agency specializing in African tech. And unsurprisingly, a lot of our clients are fintech clients. Those are the guys who've raised a huge amount of money and need to be in front of large audiences. So yes, that's what I do. So just a little bit of background. I'm going to go straight into Dario, because Dario's the numbers guy. He does data, numbers, facts. And we don't want this panel to be too much blue sky thinking, or we don't want too much theory. We want hard numbers and facts and data points as well. But as we all know, the fintech is really the big beast in African tech. It takes up the vast amount of investment, fundraising, of headline space. I was going to say newspaper inches, but no one uses that term anymore, showing my age. But Dario, it would be great to hear from you before we kind of get into the meat of like what an exit might look like. It would be great to hear from you a little more about the kind of the types of exits we have seen in the market so far. So we've mostly seen M&A. I think obviously the kind of the biggest one still is the sort of paystack exits to Stripe a few years back, but that was quite a long time ago now. So what's the data telling us about the types of exits we're seeing in fintech?
Sure. I think there was a time, Brighter's coming up to 10 years, and there was a time when we started that where the word IPO was the buzzword, and everyone was aiming at that. I think we saw the first couple of public listing happening, and that quickly turned into a reality that was more unique than actual normality, and that what the ecosystem started realizing is that the acquisition route to exit and to liquidity event was becoming more frequent. Now, I think when discussing IPOs, because I think people are asking themselves why IPOs are now happening more frequently, I think we need to probably discuss. I know that you asked about M&A, but I think it's important to probably normalize the conversation around IPO. Africa is a continent with over 50 countries, and it's a continent that is, to date, still extremely fragmented, despite the presence of the free trade agreement, despite the presence of regional clusters, despite the presence of the African Union and UNICA. And these are payments and financial sector is an rightfully extremely regulated sector, and so it's as a result growing a company that will get to a sufficient scale as to be able to capture the type of capital or generate the type of capital that then will attract public listing is an extremely hard task. And I think to date, in fact, if you look at the composition of the companies that have actually IPO'd on the continent, like not all of them are financial technology, and you probably see more work in the energy and the commerce space. Now, back to the M&A. Merger and acquisition have taken different shapes on the continent. Not all of them have been liquidity events, so just to clarify. M&A have been dominated largely by banks that have tried, Brighter itself, like for instance, we work with banks that want to know what the lay of the land is so they can understand whether they can develop their own solutions or they can buy a solution, right? And so we've seen, if you look at the exits, a lot of them have been exit into corporates and financial infrastructure, corporates and banks, and if anything, some large money movers, right? We've seen Network International, we've seen Sendwave and World Remit. I mean, these are companies that have the size of banks and the volumes of banks and are companies that operate globally. Whereas if you look at what we call the startup activity, that often doesn't take the shape of a significant liquidity event and more often probably acquire-hire situations, equity swap situations. Sorry, I've spoken a lot, but...
No, useful context, that's helpful. Thank you very much. And so, Jasil, I know that you scrutinize the deals a lot. It feels like, I follow you on Twitter, it feels like personal pastime, professional pastime as well. So look at some of the fintech and tech exits that have happened. What actually made these deals work? Was it timing? Was it product strength? Was it founder? Was it aggressive investors pushing behind the scenes? Or a mixture of all of them?
Thanks, Jessica, and thanks for having us today. I think to answer the question, I'll probably pick up where Dario left off. I think when we think about exits, we have to be careful that we're not lumping all exits into one. I think different exits have different factors. The right exit that we're all thinking about, the premium exits, quote unquote, the one that make money, it depends on a factor of things. I think timing is always important. Pace happening today is a different conversation. I think the type of product you're building, how complementary it is to the acquirer, it comes to mind as a great product, right? That's made it work. Investors for sure are going to be a big for that because despite that giving out money, I like more. And we have a lot of LPs who give us money to give us and get back, and we have years that we are supposed to get the money back, and so investors need to drive at some point to say, hey, when am I getting my money back after the last 7, 8, 10 years or so? So I'll say those are the things that cause exits to happen. But when we move away from the premium exit, I think the question that comes up is, what is the outcome that you're building for? I think if what you're building is interesting but not large enough to be a premium exit, then different things come to play. And that's where I think that we should have more of a conversation around.
And what's the scale for a premium exit? When you're saying the word premium exit, it sounds very sexy, but like, what does that actually mean as an investor? And Alvaro, I'd love you to answer that question from an investor perspective after Jasil as well, please.
I think there was an interesting article by AfriDigest where Emeka mapped out how many companies in Africa make more than $500 million in revenue. And it's like in the hundreds compared to like thousands in other parts of the world. I think a premium exit in Africa today, honestly, I know we all want to have unicorns, it's probably $200 million. Unless someone knows about the company value, they turn cash, a real number, and pricing about an opportunity I want to get to. But I'm sure Alvaro has some thoughts.
Thank you. And session, I guess, to you.
No, absolutely. It's the right question to ask and the right forum to be talking about it, right? So a premium defined by who, right? Premium defined by market, I would agree with Jasil here, right? It's 200 million, it's 300 million. We're no longer talking about building unicorns in the market because the market has shown that you can't build or that you can't exit a company at 200 million if your route is going to be M&A and if your route is going to be within Africa, right? That's not me being negative, that's just what the market is showing, right? But when you look from an investor perspective, if you're raising 100, 200 million funds, what does a premium exit look like for an investor like that? Then you're talking about billion, $2 billion, $10 billion companies, right? So is that investor and that fund size aligned to what you want to build in Africa? And are you as a founder conscious that that's what your investor is looking for in terms of return, right?
Okay, that's interesting. And quite a lot of the startups in the room are pretty early stage. So two questions. What is the route? At what point should they start thinking about their exit strategy? And what does a premium exit strategy look like for a fintech now in, say, 2 to 5 years?
I mean, happy to give a thought here. I mean, I think for founders, whether or not you think it's your job to think about an exit, as soon as you take outside capital, I think think you're implicitly taking that role on, right? If you take on outside capital, that means that your investor is looking for a return. And so you should be very conscious about what that return expectation is from your investor, and if you can fulfill it, and if it aligns with your business to fulfill it, right? So if you're very early stage today and you take a 50K investment from an angel or from a very small fund, then make sure that you know what the fund size of that investor is. Make sure you know what the return expectations are, etc. Right? And premium, again, it's defined by who, right? It's defined by the investor that invests into your fund, into your company.
A quick show of hands for the startups that we're pitching today. Has anyone already had that discussion with their investors that they're speaking to about an exit strategy? Are investors asking at really early seed stage as well? No? Okay. Work to be done then in terms of helping, I guess, educate and support startups in their exit strategy. So Apollo, you work for Luno, so a slightly different proposition, but obviously you work with and collaborate with a lot of fintechs. Firstly, have there been any interesting crypto exits in the fintech market that you know of?
I think you know the answer to that. Yes. I don't have the hard numbers, but I work at Luno. And after raising multiple rounds through various investors we've had in the long term, I would say Luno is, I think, one of the biggest crypto exits in Africa, fully acquired by GCG Group. Right.
And so what does that mean for you as a company then? What did that exit mean? How did that enable you to scale? Or did it mean that someone could just retire, or multiple people could retire? Or is there an added pressure now that you have exited?
Well, there are people who retired, but as the operator on the ground, who's responsible for making that capital produce this return that this investor would be expecting, there is the additional burden to know, say, start out entity with a founder who is more culture oriented. He wants to build for the long term. And then at some point, hey, someone is coming in and they're expecting a return, and my numbers have to look really neat, and I am not as expendable to this new owner as I was to the cultural owner, to the initial founder, and of course reduced bucks.
Interesting. Okay, no, that's a helpful answer. And then you mentioned about sort of returns. Dario, this question's for you. How do you track the market, and you track exits and growth and fundraisers? At what stage are we going to move from a kind of a funding market where there's lots of fundraising announcements, lots of capital injections, to a returns market where all of a sudden we might see some VCs starting to retire?
I was talking about this earlier today. So what we've observed at Brighter is that obviously markets go through ebbs and flows and market cycles, and there's cycles where liquidity is high, cycles where there's a lot of optimism and risk aversion is low. And clearly we are not right now in one of those cycles. But something that is probably counterintuitive has been happening. If you look at the composition of deals that have been happening across the continent the last couple of years, there's a lower proportion of late-stage deals because of a number of reasons. So the flight of overseas capital, a complete change in direction of the US in terms of foreign policy, geopolitical fragmentation and instability. But equally, there has been a massive push towards early stage investment in terms of numbers. And why do I say counterintuitive? It's because early stage companies technically are riskier as a risk profile for our investor. And yet, most of the investors have been raising for early stage funds. Now, obviously, one could argue that it's easier to raise a $5 million fund than a $100 million fund. And also the pipeline for investment in terms of very late stage could be complicated after a number of market shocks. So of course, the opposite is equally probably true. But what we have seen is that there's a massive increase in early stage investments right now. And so to answer your question, I think right now we're in a moment where we moved towards a fundraising market and not an exit market. But as a byproduct of this, if the conditions allow, over the next few years, we'll probably move into, as a result, the exit market, because many of these companies will find themselves in a position to be scaling. And then to conclude, the fundraising profile and sort of approach of investors right now is far less bullish and far less sort of speculative than it was at the beginning of the 2020s. It's far more focused on fundamentals and far more focused on revenue generation and not just ideas.
So that point on fundamentals is really, really important and really interesting as well. So again, this question is for both Jacil and for Alvaro. So Dario talks about the fundamentals. Like, how has this kind of shift, the funding landscape shifted how you do due diligence, how you kind of really drill the founders that you speak to on the fundamentals of actually pathway to profitability rather than growth at any cost?
That's right. Go. All right. I think it definitely has, I would say that it's changed the market broadly. For us at Action Ventures, we've always been a bit more skeptical on numbers, I'd say is a better word. And what that means for us is that we invest early, but we're typically looking to invest in companies that understand their unit economics. It also means that we've learned in the last 15 years or so investing in the continent that revenue takes a lot longer than you probably think it takes to scale. And so because of that, your assumptions on how quickly you're going to grow, I'm probably going to discount it by a healthy percentage. But I think that also has meant that the founders that are now starting to come up have a better grasp of what their questions and their business should look like, versus when, to Dario's point, the market was a bit more speculative.
And I would tend to agree, right? I think the type of founder that is now willing to make the jump from having a well-paid job in a corporate or a large group on the continent to now become a founder is a lot higher, right? And so you're seeing founders that have very big visions, very interesting ideas, ways, solving big challenges, as opposed to solving for very small niches. And I think building good businesses in the process, right?
That's helpful. And I'm going to keep lumping you two into the same boat, so apologies. And also, if you disagree with each other's approach, that's fine as well. But obviously, we have a lot of startups here who are starting on their fundraising journey, and they're probably going to have to start thinking about their exit opportunities and exit options as well. So what advice would you give to founders in terms of sort of mitigating potential risks when it comes to what are the mistakes that you see, and how can the founders in the room, I guess, mitigate against some of the red flags that you see with fintech companies? Alvaro, let's go with you again, please.
Yeah, I mean, when talking about exits specifically, I think the first thing that I said when we started this panel, right, have the conversation and have the honest conversation with your investor on what the return expectations are for this company, and how they see that, or how you see that aligning with what you want to build as a business, right? People think it's very sexy to raise from venture capital. It comes at a pretty high cost, right? And there is cost associated to it. And so if you have other sources of capital that you have access to, it might not be, and I'm shooting myself in the foot here, but it might not be a bad idea to look into that, right? So at the very least, know what it means to take on a VC investor and what that looks like for growth.
And actually, just sort of to build on that point, what does it mean to take it on? Like, what's the warts and all story of what does it actually mean to take institutional investments?
Yeah, no, absolutely. I mean, we can run through some quick maths here, right? And we say, let's say that the investor that's investing into your company has an 100 million fund. Each opportunity that the investor is investing into will have to return that fund multiple times, right? So that investor, let's call it, if it's a standard VC, will look to return, if it's an 100 million fund, let's call it 400 million in investment. That means that their portfolio needs to be worth at least 4 billion, 5 billion if they're exiting companies at 5% stakes, right? These are all very quick maths, and we can talk about fund structuring all we want, and I'm sure Jazel can have some thoughts as well, right? But around 4 to 5 billion is what they need to generate in terms of portfolio value, right? That means that they will have one, maybe two companies that will actually have that level of portfolio value, or maybe 10 companies that have that level of portfolio value. But what that means is that you will have to grow into 4 to 5 billion worth of portfolio value, right? So, and all within a 10-year stretch, which is usually what a VC lifetime lasts, right? Those are growth rates that are not in line with most business models in the world, let alone on the continent, right? So it's and again, this is not to have a pessimistic view. It's just to have an honest conversation of what taking on venture capital means, right?
Okay, that's helpful. And then, so Jasil, maybe you can just help us kind of like do some myth busting around, or help kind of educate all of us in the room about the exit mistakes that people don't think about, especially when it comes to fintech. Like, what could ruin an exit?
I think if you're in fintech, to Darius with your point, financial services is a regulated market. So I think the very first thing is governance and thinking about how well aligned are you compliance-wise with a potential acquirer. Because I'm sure Apollo will tell you that if the other crypto players in the space, but the reason why an investor is interested in them is because they have better compliance than a bunch of their competitors. So that's the first one. I think the second one is also aligning your expectations, what the exit looks like. Not every exit is going to be a $200 million exit. Potentially, your exit might be a larger company buying you to fold you into your company. So the question that becomes, how honest are you about the scale of your opportunity? Are you just a feature that can fit into a broader like money point, or can you be a standalone company? Those are two different like outcomes for you to kind of think about. Those are probably the two main things I'd say.
Okay, that's helpful. Sorry, did you have something to add?
Yeah, I was just about to say, I mean, when talking about exits, I think it's important to remember that companies are bought, they're not sold, right? What that means is it needs to be value in what something is buying for you to be able to execute and exit, right? And so what that means is take a look at who is actually acquiring you and how you fit into that business and what story you can tell, right? If it's a private equity acquisition, you'll have to have all your audited financials in order. You'll have to have proper governance on your board. You'll have to have probably if it's a DFI-backed private equity, then you'll have to have all the impact ESG metrics to standard. So again, know who your acquirer is, right?
That's good to know. And Jasil mentioned, and this question is for you, Apollo. Jasil mentioned like compliance, and obviously compliance and crypto have to go hand in hand. As a fintech, as a crypto platform that has exited, like what are the operational kind of issues and activities in terms of compliance that Luno has to think of every day as a fintech that wants to stay in favor with the regulators?
That's it. So Luno started operating before there was regulatory clarity in the crypto space. However, in the broader financial services space in which you work, there was some regulatory guidance. And if we go back to 2013 when Luno was founded, the founder's hypothesis was that crypto will eventually become a mainstream asset. And for it to become a mainstream asset, regulation was going to be inevitable. This was the thinking back in 2012. And therefore, if regulation was going to be inevitable, then entities that pay the cost of compliance early enough are going to have greater opportunity going into the regulated space. And we have seen this work out with the sort of partnerships we're beginning to have with large banks in South Africa, I think with multinationals across Africa. So we didn't take advantage of the situation that there was no clear regulation. We built as if there was some regulation in place. And then that feeds into having reliable operations, right? You have your compliance, but then also the service has to work to work as advertised. Settlement has to work as advertised. Your infrastructure has to be sufficiently reliable, right? And you have to optimize for cash early enough. You don't just build for growth or for scale. How are you going to get money out? Right.
That's good to know. And then, so Alvaro, I'll go to you then. So you talked about some of the things that investors might look for. How important is that operational excellence when it comes to the stage when you're thinking about an exit? And where does it rank compared to, I guess, operational excellence, let's say good governance, I guess, revenue, a team that you're like, okay, do you have a founder that can go, you can take a company from 0 to 1, but can that founder take the company from 1 to, I don't know, 50? Anything else? Like, what else do you look for other than, and please rank what you look for?
No, 100%. And I think, again, there's things that you can do in terms of being exit ready, right? Let's say, being prepared with your financials, having that operational excellence. At the end of the day, though, again, businesses are bought and not sold. So for me, the thing that ranks the highest is, do you have an attractive product? Do you have good unit economics? And does your business make sense, right? That should be table stakes before you can talk about any sort of like financial preparedness, no? Once that prerequisite is met, then you can talk about, okay, are my financials in order? Do I have the right board set up? Do I have the founder that can take this, right, from 10 to 50 or from 10 to 100, right? Will I bring in a new CEO or will I stay on as a founder? Do I have the right capabilities, right? All of these things, I think, are secondary conversations to, do I have a good business, right?
Okay, that's helpful. And so, Dario, this question is for you. So we have seen a little bit more interest. We've seen more M&A. The data's shown we've seen a little bit more M&A. We haven't seen sort of vast liquidity events, and we're not sort of we're not flooded with IPOs yet. But at what stage do you think, or what stage does the data and the trends reveal that the market is going to mature beyond than M&A activities? Maybe more IPOs, or maybe kind of bigger liquidity events, or maybe more public liquidity events?
I'm actually not too optimistic in the short term about this, and I'll explain why. Brighter has been focusing on emerging markets as well, beyond African markets. And South Asian markets, Latin American markets, not all of them, obviously, but the main markets, which could be comparable with some of the like big 4, big 5, 6 in Africa, are also not characterized by a high IPO activity. And the capital markets there are higher, their proximity to China or Japan or the US is higher. And yet the activity that you find is a private activity, it's not an IPO activity. If anything, you will find maybe more of a dominance of acquisition coming from main markets. So instead of finding an acquisition coming from Capitec or Standard Bank, it's an acquisition that might be coming from a major Singaporean, Chinese, or US company. But emerging markets are vastly characterized by private capital activity. And frankly, Africa as a whole, I know there's Burundi and South Africa are 2 different countries, but African countries as a whole are still vastly behind in terms of ability to generate that level of the volume.
And you mentioned banks there. Do you think banks should actually be leading the way when it comes to M&A, or do you think that they can do more to affect change down, in terms of innovation and in terms of acquiring some of the more innovative fintechs that are struggling to scale due to not enough investment or inability to, I guess, kind of build on the traditional structure that some of the banks already have in some of the African countries as well?
I've historically tried to be very little prescriptive and very much being an observer. But working in other markets has shown me 2 things. One is the high activity from the side of corporates, so corporate venture. And the other one is the extremely high activity of sort of parastatal organization like chambers of commerce. If you go to Barranquilla, which is like a tiny city in Colombia, and then you go to Hanoi or you go to one of the other islands of Indonesia, or even Jakarta, you see an extremely high activity from the side of the municipalities, the chambers of commerce, the local trading organization to merge the entrepreneurial world with the corporate world and with government funding. And I think this is something that overall in Africa has not happened. Like even in Kenya, which is supposed to be like the Silicon Savannah, there's Kenya, which is kind of trying to do stuff, but the activity remains extremely low. And the ecosystems are predominantly focused on the capital city or the economic capital. So you'll see Lagos, you'll see Nairobi, you'll see Joburg, Cape Town, and you'll see Cairo. You'll barely see Mombasa, Alexandria, Abuja even, or whatever, Samara city.
Alvaro, you have something to add there?
Yeah, and I think it is I think it's easy to kind of sit on this panel and say, when are the exits going to happen, right? But I think it is the job of both the founders and the investors to take that role on, right? And it's not wait for an exit to happen, but make an exit happen, right? And I think that job falls a bit more on the investors than it does on the founders, but generating those corporate relationships, you want to have funds that have those corporate relationships and that can help you get those POCs, which is usually the first step into an investment, which is usually the second step into a potential exit for your company, right? So I think a lot more engagement from investors with regulators, with the public exchanges, with corporates is key to unlock more exits in the company.
Thank you. I'm going to ask you guys one more question, but before I do, if anyone has any questions, burning questions, you should try and get some advice from this incredible panel here. So please have a think. I'm going to ask one last question, and we'll open up to questions from the floor. This is to everybody. Dario kind of gave not necessarily a pessimistic summary there, but not hugely optimistic. There's all this conversation, chit-chat about IPOs. Are we naive to even be thinking about IPOs as a viable exit option? And this is open to everyone. I'd love to hear everyone's thoughts on this.
Maybe because Anwar said something that was very clearly expressed. The 1 billion mark is being more of a curse than a blessing, because we've decided that was the mark. It could have been 785 million. You know what I'm saying? Why was it $1 billion specifically? There's no way in business logic the fact that $1 billion will be in any way a milestone for anything. And it's been a standard, and as every standard, it tended to flatten the complexity of whatever the reality was. And so what they've been saying around sort of recasting the narrative around the realities and the magnitudes of the ecosystem, I think even reframing, like you mentioned how many companies are actually generating 500 mil, but how many companies are actually generating 50 mil in the ecosystem? Do you know what I'm saying? Like, let's get the ecosystem to a level where many companies generate 25 to 50 mil. 25 to 50 mil, it's hundreds of people in formal employment, a lot of tax being paid, a lot of technology and IP being released, a lot of case studies being actually developed. Why don't we aim for that? Which is an extremely, and also for a founder, $1 billion or $50 million don't really change in terms of being wealthy.
Okay, so we have a rallying call to action there to build 50 million plus companies. Jasil, are we naive to be thinking about IPOs? Yes or no?
I don't know if I have a yes or no answer to that question. I think that we should put public markets in context with global history. Like, the most advanced African commercial civilization is still, 200, 300 years behind the U.S. The first venture capital deal that was done in America was 1985. The first venture capital deal done in Africa was 2010, maybe 11, maybe 7 if you think about Celilant. And so we're still quite far behind. I think the first question you ask yourself is, what can happen? And that we're seeing the NSC, Nigerian Stock Exchange, Joburg, trying to do the right thing, which is trying to drive more volume. I think that Dario's point, and Nairobi Stock Exchange is very clear that you need to be a 50 million AR revenue company, be in more than one market, you can list, right? I think those are the metrics to think about. And I think over time we'll get there, but we should be realistic that where we are today is within the context of where everywhere else we are looking at has been for at least 2-3 decades.
Okay, thank you very much. Alvaro, so a question to you, please, and then after you as well, please, Apollo.
Yeah, I think there is for sure an IPO path on the continent, and it depends on the type of business that you build. I think local exchanges, of course, are only have the restrictions as Jason mentioned. It's not the only path, right? It's probably the most realistic path if you do want to list, and if that's what you want to, if that's the kind of end goal. But we have examples also of companies that have built from Africa for the world, and those companies have potential to IPO outside of the African continent, right? And there's more depth in certain exchanges. You can call the Middle Eastern exchanges, right? UAE Stock Exchange or the Saudi Stock Exchange, Tadawul. These are becoming viable alternative or viable opportunities for IPOs, but it's not IPO for IPO's sake, right?
Not IPO for IPO's sake. Very good. Thank you. Apollo, thoughts on IPO? Are we being naive or should we be optimistic? Where are we?
I think it's a great conversation to have aspirationally, and it's good, to aspire and to get the most ambitious of us to, want to do unicorns and be up there. But then if we look at IPOs as a numbers game, the more the quantity of entities, of enterprises in an economy, the more likely we are going to get IPOs. Then the question becomes, how does the middle look for Africa? Are there sufficient enterprises bulking enough to join an exit pipeline, right? And it's a very personal question for me because I did, just a quick AI search. My prompt was, considering Africa's current youth bulge, right? And also rate of underemployment, right? How many jobs does Africa need to create over the next 10 years in order to capture this youth bulge without trying to think about what the hazards for the continent would mean if we do not get people in this youth bulge gainfully employed over the next 10 years. So the number I got back from AI was about 300 million jobs over the next 10 years, all right? If you take 300 million, divide by 365 times 10, it gets you in the range of 80,000 jobs per day for the next 10 years. The traditional methods of enterprise creation, which is government, development sector, or some rugged entrepreneur, cannot plug this gap. So it speaks to me that Africa probably needs a different form of venture creation that will solve needs, create enterprises that are bulky enough in the middle to pave the way for more ambitious enterprises to rise, IPO. And remember, a good value that the economy gets from IPO is distribution of wealth. People get to own productive, assets. So interesting question, interesting discussion to have.
So you've talked around the subject, but you haven't answered the question, Apollo. Are we being
Yes.
optimistic, or are we naive, or what?
We must be optimistic. So we push the top, and then we can pull up the middle and the bottom.
What a
Yes.
line to line end on. Thank you so much. Do we have any questions at all for our panelists? Please state your name, and please keep it to a question rather than a statement.
Okay, cool.
And please also direct who you like, if there's anyone in particular you'd like to ask the question to.
Sure, hi, thank you. Directing the question to Alvaro, you said that there needs to be a bit more engagement from investors. I'm curious what this exactly means for this market. Does it mean that we need a bit more private equity firms? What kind of work will it take from the private market for such to happen?
Sorry, I couldn't understand the question.
Can you paraphrase the question, please?
Sure. Okay, so you said that there needs to be a bit more work or engagement from the investment side for more exits to happen. What exactly does this look like for the private market? Does it mean that we need more private equity firms, for example?
I wouldn't necessarily, yes, on the private equity side, for sure. I think there is quite a bit of private equity on the continent. I think more marriage between VC-backed assets and PE-backed assets or PE funds needs to happen, and there needs to be a closer relationship between VC and PE, because I think that doesn't exist on the continent, and it does exist on a lot of other different markets. But for me, it's a lot more about bringing in the private capital from corporates or having closer relationships with the regulators. And again, this falls mostly on funds side, bringing in more capital from an LP perspective into funds, for example, right? There's today you have 80-90% of the funds on the continent backed by development financial institutions, right? If you can bring some of that down and have it be maybe 60-40, 40% with private capital from corporate capital, then that engages the ecosystem a lot more, right? So again, closer relationships to corporates, if I would have to say one thing, yeah.
Thanks for that, Alvaro. Do we have any other questions at all while we have this wonderful panel of experts here giving free and very, very detailed advice? Anyone else? Nope.
Okay, I'll go.
Yeah, Christoph?
You spoke about IPO and stuff, but question maybe directed for Luno. Isn't there opportunity in the age of asset tokenization to create like a pre-IPO, a layer where you could list the tokenized asset of some mature startup to generate liquidity for founders, investors, and so forth. And then, when they get to a certain stage, they can go on the full IPO. Is something Luno should do or somebody else should do?
That's a big question.
I'll take his failing us.
Okay, let me just try and get the question kindly. You're asking about the role of tokenization in supporting this funding. Was that the question?
Well, if you can tokenize the shares of a startup company, you could list them and people can buy them through this mechanism. So you'd basically generate liquidity earlier than waiting for an IPO or another type of liquidity event. I'm not saying that Luno should do that, but you have experience in that kind of
Absolutely. I think over the past 3 months, I have been in 2 regulator engagement forums with the Capital Markets Authority of Kenya. And, we are currently at the final leg of the crypto industry regulations. And I just say to the regulators in the room, look, about 10, 12 years ago, when crowdfunding was a thing with Kickstarter and a number of companies, a lot of us in Kenya had this intense regulator engagements and pushed for the passing of a crowdfunding bill. The regulators put in quite a bit of work. 10 years later, I think only one entity has had any sort of regulations under that crowdfunding bill. And then I just told the regulators, look, tokenization is actually an easy opportunity to achieve what you wanted to achieve with the crowdfunding regulations. And at that point, tokenizing shares of entities, you sort of create an easy pathway where people understand there's a thing called a cap table. You manage it jealously, and you could sort of massage it all the way towards bigger raises and eventual exits. But then also, I'm from a mechanical engineering background, and I think it's the same situation throughout Africa. At the end of your 5 years of study or even at your master's, we all do projects and we try and attack societal problems, right? And I would say 99% of those projects just gather dust on the shelves, right? Because, and I tried to solve this problem at another enterprise where I worked. We don't have capital to move from idea to prototype. Because once you prototype a hardware, then it's easier to have an investor conversation about how to productize, right? And that's another gap pre-seed that tokenization can solve. So I'm very optimistic that tokenization will find a way right through pre-enterprise to exit. And I'm hoping, investors who are looking at the distributed ledger and the AI space will help capture this opportunity.
I feel that question is going to open many, many, many more discussion points. I think we're at time. Does anyone have a burning question they would like to ask? No? Okay, well, please, a huge round of applause to the panel. They've just been fantastic. Thank you so much. Thank you so much to AfricArena for hosting us.
Don't leave the stage. Stay around for group photo. Thank you so much. A round of applause, or another round of applause for them. That was such an insightful panel discussion. And I'm just going to go through what we've been doing today. Today we started with looking at the state of fintech in Africa, moved on to how we can scale insurtech in Africa. We moved on to a conversation about stable coins. And now we've just finished a discussion on the path to exit in fintech in Africa. So I'm just going to ask the DJ to play some music as we set the stage for the awarding ceremony. Remember, we have an awarding ceremony right now. And also a reminder that tomorrow we won't be meeting here. Tomorrow we will be at Amani Gardens. So for the day 2, we will be at Amani Gardens. And we will be focusing on climate. Today has all been about fintech. But tomorrow we're going to focus on climate, so let's all look at how we're going to get to Amani Gardens for the conversations tomorrow. Other than that, we also have a VC night this evening, right after the awarding ceremony, so we can hang around and connect and network with everyone here and more people who are going to come. So right after the awarding ceremony, we're going to have a VC night and also a keynote from the sponsor of the VC night. So, the stage is ready. We are all ready for the awarding ceremony, so I want to take this opportunity to invite Christoph, founder AfricArena, onto the stage. A round of applause for him. And also our very wonderful sponsors of the day. We have Silicon Overdrive. Kindly make your way on stage. Silicon Overdrive. And also our sponsor, Verto. Kindly also make your way on stage. And also a representative from Pay Genius. A representative from Pay Genius.
Okay, how was the day? What? Ah, yes, yes. Exciting, insightful. So I just want to say a few words about that last panel. You know, in the age of AI and artificial superintelligence, we should be mindful that we already have human superintelligence. We are humans interacting, making decisions. I think it's going to become even more important, these moments of being together. So I'd like to thank Jessica for really a super job on moderating that conversation, and to all the panelists, because this was really an awesome discussion on exit. So we are just here to announce the first batch of winners. So, you know, we had two tracks competing, pre-seed and seed on fintech. Those winners, they get a lot of benefits. So they get the AfricArena machine promoting them. You know, you've heard this morning we've hit $1 billion of alumni raise for the last 10 years. So, you know, we can wish that those guys that you've seen pitching today, they are going to raise. And we are here to support them day after day. But of course, the guys who come back with a trophy are the ones that we are singling out in the announcement and so forth. All the startups that we're pitching today, they're getting benefits, AWS credits, with the support of Silicon Overdrive to implement. And they're also automatically qualified to pitch at the AfricArena Grand Summit in Cape Town at the end of the year. And last but not least, they're getting some reading. So we're very happy that every winner will get a copy of the new book, The Enterprise Jungle by Joram Winamo. And I'd like to invite the team from the Sandbox to just say a few words about that. Tell us about why should we buy this book, which is coming out only tomorrow, right?
Thank you. Good evening. The name is Lawrence Humiti, but today I'm standing in the shoes of a guy with very big shoes. The author of this book is Joram Winamo. So what this book does is, anyone who's been in entrepreneurship, we know that it is harder than it looks. Yeah, I can see the nods deep inside. It is way harder than it looks. Everyone starts thinking you're going to be the next billionaire, and the next thing you find yourself in a jungle with no money, no growth, taxes, and everything hard. So this book is giving you a snapshot and actually a navigation of how do you handle that. He himself has done it for the last 25 years successfully. He's done a nonprofit that is running. He has had a hub that is both in Kenya and Atlanta, and also a strategy consulting firm for the last 21 years. Yeah? So if there's anyone that knows all the disciplines and the ways to get through that jungle of entrepreneurship, it's Joram Winamo. So get your book, because it's only, think of 21 years, all captured in 15 USD, just 1,900 Kenyan shillings, and the book can be yours. And Wendy's going to mention something small.
Hi, everyone. I can't hear you. I feel like I can't hear you. I feel like you've not had a good day. Hi, everyone. Okay, thank you. So my name is Wendy. I work at the Sandbox, and I think something we should have said earlier, should have said, is that we've been partnering with AfricArena for the last 3 years as their ecosystem partner, and it's really, what they do is at the core of what we do at the Sandbox, and we love it, we love it, we love it so much. So for today only, we're really giving you an opportunity to be one of the first 200 people to get hands on the book. We'll be here at the back over there and somewhere in the middle here. So you can get your book today. The book launch is already sold out. Unfortunately, we are sold out, kabisa kabisa. But you can get the book from either myself or Lorraine at the back. We'll be here until when the last person leaves, let's say that. But ours is just to say, first of all, to the entrepreneurs who are getting your books today, congratulations. I hope you get all the information you need so that you don't realize entrepreneurship is not lonely. It is lonely at the top, but it doesn't have to be. Yes, thank you.
Thank you. So you can grab a book during the VC night on the table over there, and they'll be here with us again tomorrow. The Enterprise Jungle. So now, the big moment has arrived. We're going to announce the winners of the 2 awards. So do we have the awards, Naniki? Okay.
Yes, Christoph.
So Naniki, maybe a few words for our great speakers today. Naniki has been the Chief Speaker Officer. She's been at the front, at the back, at the center. Thank you, Naniki, for all your hard work.
Hi, everyone. Awesome, awesome gathering. You guys made me run around today. I just want to say thank you so much to everyone that turned out. It was a packed house. We ran out of stuff, so that's a good thing. We ran out of name badges, so that's a good thing. Speakers, panelists, judges, thank you for taking the time to be here. Without you, we wouldn't have been able to have this. And you guys make it impact. You guys give back to the founders, and we really appreciate having you guys in the house. And I hope everyone took some insights and it made an impact. And we look forward to your journeys and the winners as well. We look forward to seeing what you do.
It's Naneki's first time in Nairobi. So well done there, Naneki. Also first time outside of South Africa, I should say. Okay, so Dan, you want to come announce the winners? Because you know the winners. So we start with pre-seed.
Okay.
Who is the pre-seed winner then?
So the pre-seed winner with a large point of about, I think, 30 points more than other startups is none other than Investor Farm.
Yeah.
Well done. Can we give a round of applause again for him, please? Welcome. Say a few words. And a few words.
So thank you so much to AfricArena and all the sponsors for organizing such an event. I also want to thank the other participants. I would say before I came for the presentations, I was very nervous because it was going to be a tough call and I needed to be at my best. I'm happy to have been here and to have presented to you. I'm looking forward to working with some of the solutions that were mentioned here before, because I believe, especially in the fintech space, a lot of synergies can be shared, and that is the way we're going to move Africa forward. Thank you so much.
Okay, great. You know, it's from some of these pre-seed startups that's really their first time experiencing pitching in front of so many people, and in particular, very credible investors. So now we move to the seed track. Dan, who's taking the seed award?
So for the seed award, the one taking it is none other than Dovu.
Yeah, the Kenyan superstar in the making.
Not sure the founder is here, or if there's any representative. Dovu. Okay, no one is here. But let's give a round of applause again for Dovu.
Okay. We'll give it to them tomorrow then at the second day. So we're going to move to the VC night, but before we do, I just want to call our partner for the VC night, which is Lantern.
Collins.
To maybe kick off the evening with us. And while we're doing that and waiting for Lantern to join us, just want to again thank everybody that involved in producing this event, the AV team, the team at NSK, the AfricArena team, of course, Naneki, Dan, Thomas, who is involved with startup sourcing and scouting, and has been spending the weekend with the startup to prepare them for this and training them on the new toolkit that were released this morning, as I explained. And also the team in Cape Town that is supporting us. And again, thank you for our partners and sponsors for supporting this. So, do you want to say a few words about the VC night?
Hello, hi. I'm Collins. I'm the co-founder of Lantern, and we would love to invite you to the VC night that happens from 6 p.m. to 9 p.m. You're all welcome. So basically, so what we do at Lantern is a marketing software. We help marketing teams do the entire workflows, the entire full circle workflows for marketing teams, basically. So we handle everything from content, SEO, ads, and all that. So feel free to stick around. You can get to learn more about Lantern later on during our BC night.
What's the URL? Website?
Oh, our website is www.asklantern.com. www.asklantern.com.
Excellent. Thank you for partnering with us. And that's it. This is it for the day. You've been awesome. Thank you very much. The bar is open, right? Or opening. And we'll have some food coming out shortly. Thank you so much. And we see all of you tomorrow at Amani Garden. Have a good night.
Obatinima, Barikilimeke, Asame, I oh, empathy.